We're seeing a bifurcated S&P 500 for sure.
The AI theme is best expressed right now in U.S. large cap growth stocks.
It's hard to know who's in a bubble.
We are seeing a weakening in the overall AI story.
If it is in fact a bubble, nobody knows when it will pop.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, whipsawed by verbal intervention.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
The White House claiming it's delaying planned military strikes, helping to reduce the tension and putting a lid on crude's advance as the Treasury is opening the door for energy-starved nations to buy some Russian crude.
Which is so interesting because the Treasury Secretary is meeting with his counterparts right now at Paris, and his opening remarks was about making sure that they up the sanctions when it comes to Iran, when this administration is extending a waiver to let countries buy Russian crude for another 30 days. Says to me, Jonathan, that they are very concerned about potentially the premium we were going to see in the oil market that is going to drip into the gasoline market here in the United States.
The blockade phase, and we should call it that, has lasted longer than the so-called kinetic phase. The military strikes feel like a long, long time ago. The blockade phase comes with its own problems, so you need to do these tweaks here, there and everywhere to make sure that everyone's got enough energy. That's going to get more problematic in the months to come.
Which is why it was so interesting yesterday with an Iranian news agency coming out and saying the administration, as part of negotiations, were saying we're going to give you some waivers, lift some sanctions to get Iranian crude moving. Why would you do that if you had the blockade? I go to what UBS's Paul Donovan had to say. He said equities failed to rally because no attack is the status quo. Why did the president come out with this truth, saying that he's holding off on a planned military strike when he didn't tell the world that he was actually going to make that military strike?
The status quo comes with its own problems. You'll notice this morning the crude is pulling back just a little bit. Look at what's not happening. No rally in the bond market. No rally in equities. Yields are higher across the curve. 2s, 10s, 30s look like this morning. 10s back through 460, up by 2 basis points on the session. This from Citi. I see markets underpricing the risk of a Fed rate hike starting the year. Jim McCormick.
It's incredibly worrisome for some of these banks. They're now going from potentially we're going to have rate cuts to now having to price in rate hikes. This is another top discussion happening right now at the G7. The French finance minister basically put it, yes, energy prices are higher. Yes, inflation is higher. We might as well worry about low growth, a.k.a. stagflation. But you know what? On optimistic, and they were all smiles yesterday in a selfie, we're not in a recession.
Feels difficult, still difficult to internalize the prospect of a rate hike at some point this year. And I know I'm not the only one. Check out this language coming from Standard Chartered. We need to talk about this story. They're planning job cuts, and this is how they're communicating them. Bill Winters over at Standard Chartered with this quote. It's not cost cutting, it's replacing in some cases lower value human capital with the financial capital and the investment capital we're putting in. They have got to come up with a better way of talking about this than lower value human capital.
100%. This is not how you address your staff. This is not how you address the public. And if you are, say, a top-tier student coming out of university and you're getting offers across the banking sector, are you going to work for a company that regards you as low-value human capital that maybe you're going to be replaced in 6 months by a bot?
It's not a good look. Think about the commencement speech we saw over the weekend.
All the boos.
From the former Google boss and a host of other individuals as well, getting booed by the graduate class of 2026.
So you have these luminaries stand up on the stage and say, look, the future is going to be bright. What's happening in technology is going to be amazing. This is like an industrial revolution time. And the students are sitting there and they're booing. Do you know why? They're worried about job prospects. They're seeing their job prospects basically be evaporated by Claude, Google, Gemini, and the like.
Speaking of technology, the JP Morgan Global Technology Conference taking place in Boston. That's where Bramo is this morning. We'll catch up with Lisa a little bit later this morning, 6:30 Eastern Time. Kevin Brunner, the Global Chair of Technology over at JP Morgan. Do not miss that conversation. Equity futures this morning on the S&P slightly lower. We're down by 0.4%. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth as tech stocks slide. tonight. Bloomberg's Tyler Kendall as President Trump calls off fresh attacks on Iran. And Jeff Currie of Abaxx Markets on the next commodity supercycle. We begin this hour with stocks struggling to rally following back-to-back losses. Cameron Dawson of NewEdge Wealth writing equities became overbought and narrow, with an upside driven by a small cohort of names. This was a recipe for a pause in the recent powerful moves. Cameron joins us now for more. Cam, good morning.
Good morning.
Is that what this is, just a pause, or something more than that?
Well, it's perfectly normal and perfectly prudent to see markets pause after having what was a very parabolic advance in a narrow cohort of names that were driving the vast majority of the upside in the overall market because they became such a huge weight in the index. And we were seeing certain extremes in some of this trading. You saw flows into leverage ETFs, option flows being very extreme, and you also saw this narrowness really not be consistent with an overall new high in market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
Where do you think the bond market fits into this? New numbers again this morning. We're back to 460, 30s pushing 520 now, getting closer at 515 and up 2 basis points today. Where does that fit into your outlook?
I think that equity markets were able to ignore the bond market and ignore oil as well for a period of time when it was effectively re-rating semiconductors after a huge upside move in those earnings, meaning that the earnings were moving up so much that you had the ability to look through everything else. Now you've effectively reset the earnings, you've reset the valuations on those semiconductor names, and so now the overall equity market has to look around and say, is this valuation consistent with a 10-year at 4.6%? And what does that 10-year tell us? Because it's not necessarily just because growth is coming in a little bit better than expected. It's also because inflation is coming in hotter. What does that mean for policy? What does that mean for financial conditions?
Well, let's get to the policy call. So I mentioned the name over at Citi, Jim McCormick. Of course, Andrew Hollenhorst will have his own view on things. I think they're still looking for 3 rate cuts. But from the market's perspective, do you think we're underpricing a rate hike, and a rate hike that might come this year?
Yeah, the WIRP screen shows a 62% chance of a rate hike by the end of the year. You have a 2-year yield that's now about 30 basis points above the Fed funds rate. So we've been saying it's not a very warm, warsh welcome, because that's a really tough position to be in when you are expected to cut rates. Now, there has been a little bit of an easing in some of the commentary, we think, coming out of Trump about the urgency to cut rates, which just means that we had been talking about the potential that Warsh could be pushed to dissent at his first meeting, which would be absolutely wild, a bit unprecedented. It seems like he now has a bit more wiggle room to say, given the movement higher in inflation, given the ability for unemployment to remain stable around 4.3%, that we don't have that same urgency. It really depends on whether or not you see inflation metastasize throughout the overall economy, meaning that core measures start to pull up in a more meaningful way that could get them to hike rates. We think for now it's a hold.
And he's getting sworn in on Friday, so potentially maybe that's why the president is lowering the temperature in terms of the rhetoric. But at the same time, he's going to be there without a Steve Meyer. Who would line up with him in terms of a dissent?
Yeah, it's a really good question because he's taking Myron's seat. So we effectively remove a dovish dot from the dot plot, assuming that the dot plot does stay around. But it does move the center of gravity of the Fed over into a more hawkish stance, which just puts him in a tougher position to be able to get everybody to coalesce around his views. You know, the question we have is whether the bond market believes in their willingness to defend the 2% inflation target. The thing that continues to catch our eye, look at 10-year break-evens. They're at the highest level they've been since 2022. They've moved up by about 30 basis points. That doesn't sound like a lot, but that is a lot for break-even since the start of the war. So the bond market seems to have a lot more consternation that maybe this new Fed isn't as serious as getting inflation back to that 2% target.
If the war persists, are they going to be forced to hike and not just look through this?
It depends, again, on the metastasizing of this inflation. If we continue to see inflation really just be in that headline number where it remains contained in energy prices, we do expect it to move into food prices, but not show up in other portions of inflation measures, then they can have this potential to look through it. It really depends, I think, also on wage growth as well. That's really the ability for higher inflation to be passed on and into other areas. And what we're seeing now is that wage wage growth remains anemic because the job market isn't necessarily as robust for new jobs. But the problem you have for consumers in that environment is that real wage growth is now negative. And so as you think about the consumption outlook through the end of the year, you have effectively little upside for consumers simply because real wage growth is negative. You're seeing that in the way that markets are trading as well. Equal weight discretionary versus staples is rolling over, and you're seeing a concomitant cut in consumer household consumption forecasts within GDP. They've gone from 2.1% to 1.8%. So the market is pricing in some of this consumer worry.
Do you think a lack of clarity around the incoming Fed chair and his personal view on his reaction function, so to speak, do you think that's complicating things as well?
I think it is to an extent. I mean, the old phrase is that the bond market always tests a new Fed chair, and potentially he was more dovish in the interviews and will be more hawkish going into it. But at the end, once he's in the seat, but this is a global phenomenon. Look at what you see, of course, with UK yields, Japanese yields. I thought that the Japanese GDP data was really interesting. It came in hot on real GDP. The GDP deflator came in hot. So you effectively have nominal GDP in Japan at 5.5% with a 2.8% 10-year Japanese yield. So as much as we're talking about what's going on with the Fed, the reality is this is a global bond market that has a lower and lower appetite for duration.
Japan, the UK, Germany, it's not just the US. Cam, it's good to see you. Cameron Dawson of NewEdge Wealth is going to be sticking with us to respond to what's happening over in the Middle East in just a moment. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Donald Trump calling off what he says were planned strikes on Iran for today. Trump saying Gulf allies asked for more time to seek a diplomatic resolution, adding the US remains prepared to attack if an acceptable deal is not reached. Home Depot shares are higher in the pre-market. The company did beat estimates on net sales in the first quarter. Sales at locations open at least a year, though, rising just 0.6%, and that missed estimates. Home Depot's core business has faced high housing prices and a pullback on customers taking on larger projects. Standard Chartered says it's replacing, quote, lower value human capital with technology. CEO Bill Winters saying the bank will cut more than 15% of its back office roles over the next 4 years. And that is your Bloomberg brief. John.
I don't think you need to call McKinsey to fix that one. Vonnie, thank you. Just get in a room and come up with a better name than that.
Yeah.
A better phrase.
That's not a good phrase. Whoever decided to give that advice to the CEO, I'm sorry to say it, that person should be fired. Maybe AI would have given him a better response
phrase than that,
honestly.
Yeah. That's not a good look. Up next on the programme, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Kicking off earnings from the big retail players earlier on this morning, about 15 minutes ago. Slightly softer from Home Depot. Looking ahead, you'll get numbers from Target and Walmart. The big one, of course, coming up on Wednesday after the close, we'll have numbers from Nvidia. Heading into all of that, equity futures just a little bit softer, down by about 1/3 of 1% on the S&P, following a back-to-back slide on the S&P 500. Minor losses yesterday, very mild stuff, but still the first two-day losing streak we've seen so far through the month of May. In the bond market, yields still elevated. Up this morning by 2 basis points at the long end of the curve. 10s at 460, 30s around 514, getting closer and closer to 520. Even with this move in commodities this morning, pulling back on both Brent and WTI. Brent crude stood around 110 and down by close to 2%.
So oil potentially is leaning into the fact that clearly this administration does not want to go back to strikes, does not want to go back to kinetic war. Everyone else is sort of confused. Is this, the boy who cried wolf once again? Because why did the president come out and say we're holding off on planned strikes when he didn't tell the American people he was going back to the said planned strike? So it felt like he was looking potentially maybe for something he gets usually with an Axios article.
Whipsawed by verbal intervention once again, and that's been the experience of the last 2 months. Under surveillance this morning, holding fire against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
So here's the latest this morning. The president pausing planned strikes on Iran. The decision giving Gulf allies more time to continue diplomatic efforts with Tehran. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, President Trump says that this planned attack is off for now as he credits these regional allies for pushing for a deal. Saudi Arabia, Qatar, the UAE have all repeatedly been targeted amid this conflict. But keep in mind, the president did keep the threat of escalation on the table, going on in that post on Truth Social to say that he advised his national security team to be ready at, quote, a moment's notice for a large-scale attack. At this point, the White House didn't provide any additional details to us on what this planned attack would have entailed, as the president has long maintained that there could be the threat of military escalation, while also maintaining that a diplomatic solution is still viable. I will point out that our own analysts at Bloomberg Economics say that their analysis is that the White House very likely could revert to short and intense strikes in a bid to change the status quo, amid reporting that the president has been advised in recent weeks that limited strikes could help push Iran to the negotiating table. Because the latest is, just yesterday, both sides did reject the freshest counter proposals, as Iran says that it is not interested in negotiating around curbs on its nuclear program, and the U.S. says its naval blockade isn't going anywhere. In fact, CENTCOM confirmed just yesterday that so far the U.S. has redirected 85 commercial ships in its efforts to secure the strait. John, we're hearing from these regional allies. We'll see if any other headlines come from other countries later today, as Russian President Vladimir Putin visits China, where he is expected to discuss the ongoing conflict in Iran with Chinese President Xi Jinping.
Tyler, price of gasoline up again today, $4.53 as we go into Memorial Day holiday weekend. What's the administration doing when it comes to gas prices?
Well, Annmarie, at this point, President Trump has proposed that we could see a temporary suspension of the federal gas tax. It is our understanding that lawmakers are set to unveil new legislation related to this in the coming days. But at this point, we don't really have a firm timeline on when that would pass. And there are some questions on just how big an impact that really could have. This is an issue that has been plaguing the administration. As we know, affordability remains the top concern as we head into the midterms. A very pertinent conversation for today, as a flurry of states are holding their primaries, and we know that President Trump is facing the pressure when it comes to the cost of living. Still, many Trump-backed candidates are winning their primaries, and the president at this point is trying to urge patience with the American people, saying that this will only be a short-term disruption, as we know that those costs are still filtering down.
Tyler Kendall with the latest from the nation's capital. Tyler, thank you. We need to define what short-term disruption is now. We're 2 months into this, approaching 3 months, and maybe going through the summer. A lot of people at the beginning thought that 1 month was too long, 1 month too long, and now we're in multiple months. And at some point, you have to sit here and say this is not about the short term anymore. This is the status quo, and it continues.
You have to plan for the rest of the year, basically, and maybe as well into next year. When you talk to the administration about this, they quickly push back and rattle off the Iraq War, Vietnam, Afghanistan, et cetera, and they say, comparatively, this is very short. The issue is, when they presented this to the American people, they said it was going to be an incredibly short, just a few weeks. And now, to your point, we are months into this conflict.
So how does the consumer feel about things? We know the sentiment, if you look at UMich, is rock bottom at record lows. We'll get corporations reporting throughout this week. We had Home Depot a moment ago, weaker than expected. You'll hear from Target and Walmart later this week. Cameron Dawson of NewEdge Wealth is still with us. Cam, when you look at the data, what are you paying attention to and what are you ignoring with regards to how the consumer feels and what the consumer's doing?
Yeah, well, the mantra over the last 4 years has been watch what they do, not what they say, is that sentiment has been in the doldrums for quite some time, and yet they've continued to spend. I think the big question is now that we're back in this period where real wage growth is negative, do we see spending start to moderate? We go back to the last time we had negative real wage growth. It was back in 2022 during the last inflation spike. The difference with 2022 is that savings overall were higher and you had more room for the savings rate to drop. So effectively, there was a cushion that consumers had to dip into in order to keep spending, even though real wage growth was negative. The big question is as we go into this summer, could we see them start to pull back on spending? Does that start to show up in things like economic surprises? Remember, there's a really tight relationship with economic surprises and the 10-year yield. So if you're looking for a bond rally, that could be the source of it.
What's the relationship between that and the stock market, weighted to something very, very different away from the US consumer?
When we think as equity investors of when geopolitical events matter, it's when you have a prolonged increase in oil and retail gasoline prices that eventually weighs on GDP and eventually weighs on earnings. And that's been the disconnect this time around. We're cutting GDP estimates, but we're raising earnings estimates, not because the economy is necessarily holding up broadly on a better basis. It's because you have this one cohort of names, being the semiconductors, who are seeing massive earnings estimate upsides. You've seen the SOX increase its 2026 estimate by 42% this year. That masks a lot of weakness under the surface. And you see it within the GDP line as well. Look at household consumption forecasts going down, but private fixed investment going up. So were it not for AI, this would be a very, very different story for the economy as well as the overall equity market.
You mentioned, Cameron, what happened last time we saw higher inflation and consumers went into their savings. Aren't they getting tax refunds that are bigger than they normally would this time around? How is that helping them?
Well, it's effectively helping to offset some of the increase in oil prices. What effectively the math has been working out is that the increase in gas prices has effectively offset the benefit from the OBBB. The big question is how long do these gas prices persist? It is a duration question. So now that we're effectively offsetting those tax cuts, if we continue to see oil prices and gasoline prices remain elevated through the end of the year, we're watching the Brent December futures like a hawk, effectively saying that's the market finally coming around to the fact that this could be a more prolonged issue. And if you continue to see high gasoline prices, then that's where you'll start to see the pain. So it all comes down to duration.
At any point, will higher gas prices hurt the likes of a company like Nvidia that are holding up the S&P 500?
Yeah, we'd like to think that we all do breathe the same economic air, but it's multiple steps away. I mean, the people who are paying for all of this capex are companies like Google and Meta, who are primarily advertising companies. Meta's 98% of its business is coming from advertising. That is a cyclical business that is, in fact, related to overall economic growth. Don't forget, Meta had negative revenue growth in a year like 2022. So if you were to see more pronounced economic weakness, then certainly it could filter through, because the reason they've been able to spend so much on Nvidia chips is because their core business is so strong because the economy has been holding up.
Cameron Dawson of NewEdge Wealth. Cam, it's good to see you. Thank you. Reminded me to look at the December futures contract on the Brent curve. Looking at the Brent futures curve, we're trading above 90 all the way out through December. That contract right now, as I'm looking at it, 91.55.
Markets starting to wake up that this might be a prolonged conflict, or at minimum, this might mean that structurally it has changed in the region where Iran has a bigger control of the Strait of Hermes, and it might not be smooth sailing as it once was. And you have to start to incorporate more geopolitical risk premium into the oil price.
Won't be smooth sailing for Kevin Walsh either over the Federal Reserve. This is why things are slightly different compared to how they have been over the last 10, 15 years or so. The last few Fed chairs have come from the existing Federal Reserve Board. So they aren't unknown entities, so to speak. Neither's Kevin Walsh, but this is slightly different. He hasn't been on the board for a long, long time. We understand his views, but only really in media circles when he's sort of having a go at the balance sheet and QE and things like that. We don't really know what Kevin Walsh stands for coming into this Federal Reserve. Things are slightly different compared to what we knew about Powell and what we knew about Yellen.
That's why this first meeting is going to be fascinating. Is it the Kevin Walsh that we knew when he once was at the Fed, who was a hawk, or the individual that interviewed the President of the United States and gave testimony that sounded very dovish? Which Kevin Walsh is actually going to show up?
Yields slightly elevated across the curve again this morning. 2s just north of 4%, 10s back above 460, and 30s. 30s just feel unhinged worldwide at the moment. The long end of the curve feels very untethered. Yields up by 2 basis points, 514 on 30s. Up next, we'll catch up with Kevin Brunner of JP Morgan on the outlook for tech investments and M&A. Pulling further back from all-time highs on the S&P this morning, negative by 0.4%. Back-to-back losses on the S&P, the first two-day losing streak of the month so far. Yesterday's losses very mild. A turnaround in the equity market as we got a bit of verbal intervention from the president about delaying planned attacks we didn't know were even happening. In the commodity market right now, crude pulling back, Brent and WTI. Brent down to 110, down by close to 2%. You take that screen and typically you can predict what's happening in the bond market. Not this time. In fixed income at the moment, 2s, 10s, 30s, yields creeping higher. At the front end of the curve again up by 2 basis points. 10s still around 460 and 30s north of 5%. Your 30-year yield up by a basis point or two. More on the bond market a little bit later in the programme. That's across asset price action. Let's get you some single names, some morning movers. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, let's start with a little read into the consumer, and particularly an interest rate sensitive area, right? So Home Depot out with earnings. It's actually higher now, but it did miss estimates in terms of comp store sales. They were up 0.6% as opposed to analyst estimates for 0.9% of a gain. Consumers just not buying those big houses or engaging in those massive projects in their houses, right? But they are doing a little gardening, and so things weren't all that bad. As I said, Home Depot holding on to its guidance for the full year, and basically margin guidance as well is what it had said earlier. Now that does miss estimates. We'll see what executives say on the conference call that's scheduled for 9 a.m. Eastern. Let's move on because we have another AI deal today, and in this sense it is an AI infrastructure deal. So BlackRock, through its funds, investing $5 billion with Google in order to gain access to Google TPUs through an infrastructure project. It will be competition really for CoreWeave. So CoreWeave selling off just a little bit today, although CoreWeave has had a lovely run up, but positive for both of these players. Blackstone expects to see 500 megawatts coming online by next year. It's a massive amount of energy. And then let's take a look at the memory chip makers, because of course we saw the Seagate CEO's comments yesterday cause a little bit of a sell-off for that stock. It was down almost 7%. He basically said, look, we're not going to be building massive factories. It's probably not going to be worth it. It's going to take too long. It's going to be 5 years before they're online, and at that point who knows what memory chips will cost, causing another little bit of a sell-off today. But I mean, in relation to the run up in these prices, I mean, if you look at just SanDisk alone and Seagate, they've been up multiple hundreds of percent. Micron up 600%, 3,500% gain practically for SanDisk over the last year. So I think they can sell off a couple of percentage points. It won't break the bank, John.
Hey, Vonnie, thank you. Appreciate it. Massive run up for those names. A bit of negative follow through so far this morning. On our radar this morning, President Donald Trump calling off a planned strike on Iran after speaking with Gulf allies. Trump announcing a pause for, quote, 2 or 3 days, saying the countries are very close to reaching a deal.
If we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Tehran yet to confirm the latest round of discussions. Elsewhere, Standard Chartered set to cut its support staff by more than 15% as it builds up its use of AI. The CEO, Bill Winters, saying the bank is replacing, quote, lower value human capital with technology.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. And finally, the Nvidia CEO, Jensen Huang, is saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following his visit to Beijing with President Trump.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, notably, yet to sign off on accepting Nvidia's H200 chips following the US greenlighting access for some firms there.
They greenlit it, the United States, in January. Then once again in March, Nvidia said that they did get some orders. But then those customers went to Nvidia and said, actually, we're not allowed to go through with the purchasing orders. So now we wait and see if the summit produced potentially China and the CCP telling these firms they can buy it. For Jensen Huang, he's definitely hopeful because Nvidia said that it's a $50 billion opportunity when it comes to China. The real question I have is China worried about national security risks within their own market? Do they want to make sure that they can almost ring fence their own AI? Or do they feel like they don't even need the U.S. chips anymore? And if that's the case, how much leverage has the United States lost at the negotiating table?
Nvidia, a difficult couple of days, down slightly again so far this morning. Let's talk about technology. JP Morgan holding its annual TMC conference over in Boston. Bramo's there at the event with a special guest. Good morning, Lisa.
Good morning, John. Thanks so much. I am here in Boston at the TMC conference held by JP Morgan with the global chair of investment banking and mergers and acquisitions, Kevin Brunner. Thank you so much for being here with us today.
Thanks, Lisa. I really appreciate it. So, thank you for being here, by the way.
Well, this is such an interesting moment because it seems like the AI cycle is driving everything right now. You've been working on tech M&A for 25 years. How is this moment different than previous ones?
It's completely different. It's impacting every client that we have. There's not a client that we talk to that's not actually thinking through where they are in the landscape, what's their long strategic narrative, and how they're going to adapt to a changing environment.
What's driving most of the tie-ups right now? Is it the idea of trying to get economies of scale? Is it to shore up cash, to invest more efficiently, or is it just sort of a quest for survival?
You know, I actually think the M&A market can be defined by selectivity, scale, and really creativity these days. And so we're obviously seeing strategic acquirers be highly selective in where they're putting their capital use. The deals they're doing are actually done with high conviction, and they're actually changing the long-term narrative for a lot of these companies, and that's probably the number one focus. At the same time, scale's very important. So cash flow to be able to reinvest in the business is very important. We've seen the equity markets really embrace what I would say is scale overall. And frankly, when you're going through business transformation at the same time, scale's been very important to be able to fund that. And then creativity's been the most interesting part. We've seen deals of all type, minority investments, we're seeing collaboration, we're seeing consortiums do deals together, we're seeing partnerships, a lot of structure, and that creativity, I think, is something that's really very interesting to me as we look forward.
What are some of the barriers to these tie-ups? I mean, how high is the threshold? We've been talking all about how bond yields have been surging to the highest levels going back to 2007, at least in the 30-year in the U.S. Globally, you're seeing long-term yields rise. At what point does that stymie some of the activity in deals that we've seen so far?
You know, I think capital has not been putting a barrier on M&A whatsoever. Obviously, we have a constructive regulatory environment. And at the end of the day, I think while we're trying to balance all the geopolitical and all the macro issues that are out there, at the same time, it's so imperative that many of these companies change their long-term strategic narrative, that we're seeing people push forward, do deals of size, and making sure they're actually repositioning themselves on the chessboard for the path forward.
We've seen a lot of mega deals so far this year. That has been the driver, at least in the overall volumes. Is that the same in technology? Does it have a different flavor?
Yeah, it's a great question, because technology a little bit is a tale of two cities. AI is actually a catalyst within technology, and it's also a disruptor. So we're actually seeing those companies with AI tailwinds be very acquisitive, adding capabilities, adding different tools to their system, and making sure that they're continuing to reposition themselves to be the leaders that they are today. On the other side of the technology market, we've obviously seen a little bit of a pause. We've seen people assess their own business models. Where are they in this evolution? But I actually think that uncertainty as we go forward is going to actually turn into differentiation in the marketplace. And that differentiation is going to lead to continued consolidation, more traditional M&A activity, I think, in the second half. And we're really enthused about that.
Can you put some specifics around this in terms of what we're actually talking about? I mean, is it the hyperscalers versus the software guys that are all fighting for survival, that are all going to try to band together or else die?
Well, let me tell you where we think we'll see differentiation on the software side, right? So we're going to see, obviously, companies of scale. We'll see mission-critical platforms come through the other side. We'll see systems of action, right? Obviously, I think there's a lot of discussion around SaaS moving to an outcome-based platform. We'll also see what would be companies with data moats come out the other side. And that differentiation, obviously, we went through one earnings season. We're going to go through another one here in a couple months. And I think we're going to lead to those that are actually have reassessed their models. They put the moat around their business, and I think those are some of the characteristics we'll see.
Would you say in the next year this is going to be a big shakeout period where some of these models get put to the test in the way that they haven't so far? Which are the ones that actually can be deployed in an effective way, and those that can't, and that ultimately go away?
100%. I think we're going to continue to see, and maybe see even a little bit more than we have today, the capital kind of focus into the winners. This is more on the hyperscalers, the large providers, really building out the infrastructure. On the other side of the market, we're going to see consolidation, right? As we hit that point of differentiation, we're going to see the winners. The winners are going to be acquisitive. The winners are going to add to their portfolio. They're going to apply the same techniques that they actually applied to their own business, and we'll start to see them build their scale along the way to have all the benefits that we were talking about previously.
How much pushback are you starting to see from investors, whether it's the private capital or whether it's public markets, in terms of financing some of these transactions, given how much risk is coming in and given the competition for capital elsewhere?
Yeah, investors have actually been very resilient. Investors obviously on the top of the market, right, where there's a lot of growth and there's a lot of AI tailwinds, everyone wants to participate. We've obviously seen a pause on the other side of the market where the transformation's taking place in the business models. But as that differentiation starts to happen, we're going to see investors be very focused. I mean, I expect, take private equity, for example, let me back up. Private equity actually has been very focused on being patient, assessing their own business models. They're part of the creativity I talked about. But as we move through to the second half and we see that differentiation, I think we're going to see capital for take privates. I think we're going to see capital for consolidation. And I think that'll come from both sides of strategic and financials.
Do you think that we're going to see also a lot of failures among some of the private equity firms that have had companies that have not gone public for a very long time because they couldn't reconcile the valuation that they were booking versus the valuation they could get in the markets, and they have to kind of do something with that in order to free up cash to be able to go out there and do something?
Well, a number of the private equity veterans are obviously very AI savvy, very focused on the transition. We're actually reading now, about some of the new announcements, partnerships, collaborations that are taking place. And I think we're clearly going to see some winners, but with all success, there's obviously some that'll be on the other side of it.
This is one of these annoying questions that help benchmark where we are. Where are we in this process? I hate using the innings kind of analogy, but yeah. I'm going to use the innings analogy. Where are we in this process of build out with respect to AI?
It's still early, but as I look at the conversations taking place here at the conference, we've really moved from it just being AI, agentic, infrastructure build out to actual execution and scaling as part of the plan. Every company here is very focused on what's their long-term strategic narrative and are in the early stages of doing so, but we've actually gone from hype to real execution and scaling.
This, to me, is a fantastic moment to be speaking to all of you. Kevin Brunner, thank you so much for being with us. Kevin Brunner there, the chair of investment banking and mergers and acquisitions. John, I will send it back to you.
Lisa, thank you. Great work. Looking forward to Lisa's coverage throughout this morning from Boston. From New York City this morning, let's get you an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. 3 people were killed in a shooting outside an Islamic center outside San Diego. Authorities say 2 teenage suspects were also found in a car with apparent self-inflicted gunshot wounds. San Diego's mayor is saying there'll be extra police protection at local mosques. EU officials meeting today to try and finalize legislation for a trade deal with the United States. They must reach an agreement by July 4th to avoid triggering higher tariffs threatened by President Trump, who previously threatened to raise those levies on European auto imports because the EU hadn't moved quickly enough to implement the deal. Fund managers boosting their stock allocations by the most on record. The May Bank of America Fund Manager Survey shows managers are the most overweight equities since January of 2022, and they've made big cuts to their cash levels. The survey identifying inflation as the biggest tail risk. That is your Bloomberg Brief. John.
Hey, Vonnie, thanks for the update. More from Vonnie in about 13 minutes' time. Up next on the programme, AI meets the physical world.
If we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
Up next, we'll catch up with Jeff Currie of Abaxx Markets from New York City. You're watching Bloomberg TV. The losses resume. We're down by 0.5% on the S&P. On the Nasdaq 100 this morning, pulling back by some 0.8. On the Russell, small caps, negative by 0.7. Under surveillance this morning, AI meets the physical world.
Memory is one of the main areas of constraint right now because there's not enough physical clean room space to put the tools in place to build all the memory we need for AI. Months ago, the big concern was that we wouldn't have enough demand. Now, if we're getting to a point where we don't have enough supply, what that means is there's more duration to the good news. We can't be in a bubble if we don't have enough capacity to supply all the demand right now.
So here's the latest this morning. The Seagate CEO, Dave Mosley, issuing a warning for the AI build-out. Mosley telling a JP Morgan conference that building new factories would take too long. The comments weighing on memory and hardware makers after plunging in Monday's session. Jeff Currie of Abaxx Markets writing, capital has chased the AI trade while ignoring the physical assets it requires to run. Assets that have quietly become the best performing asset class of the decade. Jeff joins us now for more. Jeff, welcome to the program. I've been excited to catch up with you, sir. I think we need to take a giant step back and think about the mining bust post-China boom. We need to think about the shale bust of a decade ago and why that set the stage for this period of what you call capex starvation. Just where are we and why?
Well, when you look at history, going back the entire post-war era, there's two sectors that lead the equity market. One is energy, the other is tech. If you can't turn on the lights, nothing happens. If you can't innovate, you never progress. And that's what you see. So we go back. Tech was a leadership in the 90s all the way up to 2002. Then we transitioned into energy. 2002 to 2014, 14 to now has been technology. And the way you think about it is in those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Inflation gets low and stable. Interest rates drop. And investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity. And that's where we are today. With this geopolitical event, it just pulled forward. And Jonathan, we've been on here talking about the revenge of the old economy over and over and over. This rotation out of tech into hard assets, that was already underway before this happened. What this did is just accelerate it.
As you know, Jeff, discipline has really hardened at some of these C-suites. What will it actually take to break out of this capex starvation phase that we're currently in? And do you see us breaking out of it anytime soon?
Higher prices, higher returns. But ultimately, you ask, what creates that huge upward trend in prices that you saw in the 70s and you saw in the 2000s? It's once investors take capital out of tech, dump it into commodities, they begin to spend, and then you get cost inflation. The PPI that came out last week at 5.1% is telling you you're already seeing signs of it combined with the huge supply shock that you're seeing in the Middle East. So in terms of thinking about where we are on that, we are just in I'd say the bottom of the first inning of the super cycle, despite the fact commodities are the best performing asset class this decade. So you're already 6 years into it in terms of pricing. And when we think about the forward, you've probably got another decade to 12 years left, just looking at history.
Jeff, this is important. Let's just compare what's happening with tech then. So I imagine you think as capital intensity picks up, capex intensity picks up, at the tech players, we get a re-rating. And then you get the rotation into the more energy-sensitive parts of the market, the mining sector, the energy sector. We're not seeing that equal and opposite move, though. In fact, Jeff, those particular parts of the market have lagged so far. That's interesting to me, that the energy names haven't done much at the moment. What gives?
I think right now there is no concern about the supply of energy and commodities. Even with the largest supply shock the world has ever seen, 2x what we saw in the 1970s. And I think there's three reasons why they're not concerned. One, we're in the middle of the shoulder months. This is the weakest demand that goes down and then back up. We're in that weakest demand part of the entire year right now, so there's no stress on the system. The second reason is right now we're in a deficit, meaning that demand's up here, supply's down here. We're drawing inventories. Once you exhaust inventories, boom, you have to push demand down in line with supply. That's when the shortage hits, that's when the pain hits, and that's when prices go nonlinear. The third point I want to talk about is that every policymaker, macro forecaster, central banker, tech promoter is telling you right now there is no problem. Every commodity CEO, commodity trader, anybody who gets their hands dirty is telling you you have a problem. You have seen this movie before back in 2020, 2021, when, remember, inflation is transitory. And then, a few months later, boom, you hit the wall and, we went to double-digit inflation. And I think you're seeing the same dynamic here. One last point, though. Carter in 1977 made a fatal mistake. It was the sweater speech. It was, February 1977. He's wearing a sweater kind of like this. Went out, she was brrr, and told everybody, turn your thermostats down, and then prices of commodities explode. And I think every policymaker has learned from that, you don't want to create fear. My job is, if I was advising the president, telling him to do the exact same thing, keep everybody calm. But my job is telling you how to make money. And at this point right now, this is really serious.
Yeah, Trump definitely doesn't want to come out, especially with the 95-degree weather, saying don't put your air conditioners on. But Jeff, you say that at this moment, supply has never been more constrained, yet Brent can barely hold on to 110.
You have that seasonal weakness right now. You're not in a shortage. But another really important point here is because nobody is buying the energy companies. In the back end of that forward curve is anchored to the cost of capital of those companies. It is too low. And, I call this the biggest asymmetric trade in modern finance in historical terms. Why? When you look at the free cash flow yield of the oil companies, they're 15.5%. The hyperscalers are 0. Let me say that again. 15.5% free cash flow yield for the oil companies, 0% for the hyperscalers. We call those oil companies the Munificent Seven. What does munificent mean? Giving you lavish gifts. And at 15.5% free cash flow yield, I'd call that a lavish gift.
And just when it comes to supply and demand, you mentioned this, it's going to get rough when inventories are drawn down. When will we hit tank bottoms in your analysis?
It depends on where you are in the world and what products. Some products, you're already there, like motor oil in the U.S. And by the way, motor oil in the U.S. is critical because you couldn't even turn on your car without motor oil, even if you had gasoline. Items like sulfuric acid, you're out. What does that cause? That's why copper hit an all-time high last week, because you need the sulfuric acid to produce copper. But when we think about diesel, jet fuel, gasoline, those parts of the world, jet fuel, you're there. We would expect to see here in Europe, diesel and jet fuel run into very serious problems by the end of this month. The United States, gasoline by July. And at that point is when you start to get to that nonlinear part and see prices go higher. But I want to emphasize, when we look at the spread between spot prices and the back end, this spread has never been higher. And everybody goes, oh, we had, prices were at 122 in the Russian invasion. By the way, the back end of the curve was $10 lower. And then everybody goes, we saw 147 in 2008. By the way, the back end was at like 140. So 147, 140. What is mispriced here right now is the back end of the oil sitting somewhere around 70, 75. This is a long-term problem. The cost structure is going to go up. There is no spare capacity left. It's going to take a long time to reestablish it. We need to reprice that market. That's going to reprice the Munificent Seven. That's why I tend to think the trade here, just looking at pure economics, has the most upside to actually own these oil companies.
Jeff Currie, fired up. Jeff, when you're next in town, you need to co-host the program with us.
Yes.
Looking forward to that. Jeff Currie there of Abaxx Commodity Exchange over in London. Maybe bring Michael O'Leary into the program as well from Ryanair. Perfect lineup.
And I also think they have different views on jet fuel at the moment when it comes to Europe. So I'd actually would love to see them around the table together.
Up next on the program, we'll catch up with Steve Auth of Federated, Henrietta Treyz of Veda Partners, Drew Redding of Bloomberg Intelligence, and Michelle Meyer of the Mastercard Economics Institute. The second hour of Bloomberg Surveillance is just around the corner.
The major macro indicators are actually pretty strong.
Begrudgingly, the consumer has held on to their spending trends.
The U.S. consumer is in a better position than most of the world.
The bond market is definitely, the narrative is driven by inflation right now.
I don't think that these interest rate levels are helpful, if anything.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Two-day slide on the S&P 500, negative this morning on the S&P by another third of 1%. In the bond market, yields elevated through the curve. 2's around 4%, 10's around 460, 30 still north of 5% on a 30-year yield in America, a number we haven't seen for quite a while. You've got to go back to 2007 for yields that elevated at the very long end of the yield curve stateside. The problems in the bond market, not just a problem for the US, a problem for the UK, for Germany, for Japan as well. Japan, the one to watch through the week so far. In the commodity market, check out crude this morning, Brent and WTI. Brent crude is a little bit lower, WTI as well, but that's not unlocking gains in this equity market. That asset class whipsawed by the verbal intervention of the last 24 hours.
Once again, how many times have we been here from verbal intervention from this White House? The president coming out and saying that at the request of Arab partners and allies, that he is going to hold off on our planned military attack on the Islamic Republic of Iran, which was scheduled for tomorrow. What I find so interesting is no one knew about this scheduled attack, but the president decided to tell us he's holding off on an attack that no one was expecting. For the oil market, though, this obviously everyone is clinging to the fact that this White House wants to wrap up this conflict. On top of that, they're also extending a Russian sanctions waiver to allow more Russian crude to stay on the market.
And there's an important why to that. You have to keep massaging the story. Find little pools of crude and energy here, there and everywhere. Unlock them while you can, just to make sure that this crude price, this move, doesn't get away from you. We heard from Jeff Currie, legend of the commodity market, about 10 minutes ago, talking about how much time we have left before this becomes an even bigger problem. It hasn't become an even bigger problem because we've been drawing down inventories aggressively, not just stateside but worldwide, over the last 2 months.
Yeah, we're living on inventories right now. We hit tank bottoms on these inventories. That is when the commodity complex is going to get incredibly challenging, and we can see parabolic moves. We don't see them yet. What is important to keep in mind is that depending on where we get into the inventory levels, how low we get, depends on where you live. And that's what Jeff Currie said. That's what we heard from Michael O'Leary yesterday. It's going to be much harder in Asia, as it has been, and then it's going to ripple through to Europe and then potentially pockets of the United States.
Stock so far this morning, slightly softer, not a major move. Think about the run-up. The run-up's been absolutely massive. The losses have been muted, very mild yesterday, adding to the losses on Friday. Two-day losing streak could become day 3, down about a third of 1% on the S&P 500. My port in the storm, my bullish port for a long, long time has been Steve Auth of Federated. And Steve has this to say: stocks can pass through and or manage inflation, especially when productivity is booming due to AI. We're raising our forward earnings and market targets despite persistent inflation worries. I'm pleased to say that Steve joins us around the table. Steve, good morning.
Good morning, John.
You're the guy I turn to and have done for the last decade or so to kind of get me out of this bearish mess or this hole I've dug myself into. Why can you still be optimistic in a moment like this one?
Well, I was thinking of this as Annmarie was talking about hitting bottoms on tankers and things. We have an expression at Federated Hermes: if it can't happen, it won't happen. And sometimes you can outsmart yourself. You're looking at everything and saying, this looks really bad, but we're not the only ones who see that. And so I have to assume that some combination of Donald Trump, President Xi, the whole crowd, this is not good for anybody. And so I don't think we are going to run out of oil. I think they'll figure out a way to solve this one way or the other.
As you say that, I'm reminded of what happened yesterday, this Iranian report that part of the negotiations, this is what the Iranians were saying, the United States was willing to give waivers to Iranian crude. If the situation gets so bad, they're just going to let crude go freely from their enemy that they're in a conflict with?
Well, I think that they do whatever they have to do to have this not be an issue. And in the meantime, the other thing that I think people are sort of missing here is bond yields are up because inflation's up. But bonds are the asset class with a problem, not stocks. Stocks have always been an inflation hedge. It really doesn't matter what inflation is doing. If you look at the data and sort it, as long as growth in earnings is strong, stocks go up. Whether it's driven by inflation or driven by real growth, it doesn't really matter because stocks eat nominal earnings. And look what just happened, in the last earnings season. 8 of 10 sectors had double-digit earnings growth. People talk about a narrow recovery, and it's one of these fallacies where people look at percentage moves off of lows. Absolutely off the lows, the AI stocks have driven the rally. However, year to date, and I was kind of laughing during your last telecast, you're talking about how it's AI-led, and in the background, they're showing the returns on Exxon, up 33% year to date. Year to date, value stocks, small cap stocks, emerging market stocks have all performed double-digit ahead of the Mag 7, which is up 8%. So this is not simply an AI-driven rally. It's a broad rally. AI itself is spreading out. The AI theme keeps spreading from one thing to the next. It's all over the economy. This is one of the biggest technological changes in the history of man. And the trajectory of earnings right now, based on what we're seeing and what has been coming out of the street, as street estimates keep rising every day we go through earnings season, we found that our number, we had a number, we always use a 3-year out earnings number to project a 2-year forward market return, which at the time we were at 8,200. The number keeps going up. We had a $400 earnings estimate for 2028. We were way ahead of the street 6 months ago. You know, I woke up Monday morning and we're behind the street. How could that be? The street's now at 425, so we're at 450. If you look at the numbers, that's what's happening. Stocks are passing through, and productivity gains are helping them, you know, pass through. And their margins are going up, not going down.
Steve, this is the struggle people have, and I had this conversation with Alex Altman over at Barclays, that we seem to be putting more emphasis on how we've got here and not enough on where we are. And a good example of that is, say, look at the charts versus look at the numbers. If you look at the charts and look at the parabolic move, particularly in chips, coming off the March low, you can see why a technical strategist becomes a little bit unnerved about how detached we've come from the daily moving averages.
Yeah.
But if you look at the actual numbers, there's a source of comfort there. Do you have that struggle speaking to investors at the moment? They struggle to detach one from the other and just focus in isolation. Look at where we are, and where we are is okay.
Right. I try to focus our clients on where we're going, and that, I think, helps calm everybody down. For sure, as a technical strategist, and all the ones we work with are all telling us, you know, we're overdue for a pullback after a sharp run-up. Absolutely. Absolutely. And one reason we'll put out a bullish note like we're about to do here, you mentioned our new target on the S&P 9,000, is we're almost anticipating a correction. And we want to get ready, get people ready for that. And actually, the situation in our mind is actually getting better, not worse. Technically, we're certainly overextended. Could be a pullback. But it's never as deep as you think it's going to be.
You've alluded to the challenge, though. You need to think about pricing this market for the economy we'll have 12 months, 18 months out, further down the line.
Yeah.
Not the one we've got. That's another struggle for a lot of investors. They look at the economy we've got. They look at the energy price move. They hear Annmarie and the prospect of things getting a little bit messy later this summer, and they struggle.
Much to less, Lisa's not here.
There you go. It could have been even worse. They struggle to think about where the economy will be 12 to 18 months on a rolling basis. Just walk us through your discipline with regards to that.
Yeah, well, we just look at the underlying, what's going on in the economy and in the companies, because we're talking, our analysts, we have 170 PMs and analysts in the equity group at Federated Hermes, so we're talking to companies every day all over the world. And what they're telling us is that the situation looks pretty good. They're all seeing their sales are expanding, their earnings, their margins are going up, and their earnings are going up. And it looks to us, as AI gets more and more adopted into the economy, that margin expansion trend is going to continue. This is one of the things that has made us more bullish than the average bear or the average market investor. Most people keep talking about peak margins. We've heard about peak margins for a decade. And yes, that has always been true. Every time someone has said that, we are at peak margins. And guess what? The margins keep going higher because the mix of companies in the economy is getting increasingly mixed towards higher margin businesses, and even the older companies are improving their margins, partly because they're using AI.
Do you think this story can continue in the way you're describing it if the Federal Reserve has to hike interest rates?
Yeah, I think, well, I don't think the Fed is going to hike interest rates, so that's a loaded question. But even if they did, yeah, the market would probably have a quick
do you think
pullback.
They're going to cut?
But I said earlier, I think bonds have a problem, not stocks. Stocks are growing their earnings at double-digit rates. Bonds can't grow their revenue stream unless there's a rate hike. In fact, They need to get bond yields higher to compete with stocks. That's been the problem.
You keep talking about the E. If we've got a problem with the bond market, will we have a problem with the P in the equity market? The price that people are willing to pay for those earnings if yields start to continue backing up like this.
Yeah, it's fair enough. The discount rate could go up marginally. But look what's happened with the earnings growth rate over the last 3 years. It's way above the increase in the discount rate. So I think you can get overly focused on that. It will certainly cause a near-term correction. If the Fed turns around and hikes, which I doubt that they would do. If you think about it, Annmarie, it's like a bifurcated economy here, right? The low end right now is being protected by the one big beautiful bill. That's offsetting the gasoline price hike by 6 to 8 months. The high end's being protected by the wealth effect. So that's why the economy is going along. The Fed, if it raises rates, what that is going to hurt is the interest rate sensitive part of the economy, which is not as big a hunk of the economy as it used to be. And it's the part of the economy that currently, right now, is sort of in a recession. Look at Home Depot's numbers this morning. So the housing market is the thing that's struggling. That employs a lot of people. That's the area that needs lower rates. And Warsh understands that. So I think it's really unlikely that he's going to hike. All he's going to do is further hurt the part of the economy, the one part that's not growing fast. And it's not going to have anything to do with AI. The investment there is being driven largely by cash flow, not by borrowing. So it's not going to have any impact on the AI boom.
Just to remind us, just to wrap it up, new price targets, what are they?
We've gone to 9,000 for the end of 27, and we're at, I want to say, 8,000 for the end of 26.
Pretty bullish stuff, Steve. It's good to see you.
Yeah, likewise.
Appreciate it, buddy. Thank you. Steve Auth of Federated Hermes. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. We're getting new details about President Donald Trump's meeting with China's Xi Jinping last week. The Financial Times reporting Xi told Trump that Russian President Vladimir Putin may end up regretting invading Ukraine. Putin is in Beijing and scheduled to meet with Xi tomorrow. A legal setback for Elon Musk. A California jury tossing out his lawsuit against OpenAI and its CEO, saying Musk should have sued sooner. The jury didn't rule on his core allegation that OpenAI abandoned its responsibilities by pivoting to maximize commercial profits. Musk says he'll appeal. The LIRR strike coming to an end after 4 days. Railroad workers agreeing to a potential agreement to get the country's largest commuter line back up and running. The unions still need to ratify the accord, which delivers raises for workers while protecting riders and taxpayers. And that is your Bloomberg Brief. John.
Some good news going into the long weekend. Vonnie, thank you for that. More from Vonnie later this hour. Up next on the programme, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. A summer tease from New York City, getting into the 90s a little bit later. For the Brits out there, for the Europeans, that's 34 Celsius. Into the 90s.
It's unbelievable.
Sneak peek of the summer.
The Brits don't experience this ever, so come to New York. What's sad, though, is that it's not carrying through the weekend, which is a long weekend for Memorial Day. So.
Temperatures are going to come down pretty aggressively over the coming few days into the long weekend. That's the situation with the weather. This is the week ahead for the economic data and the earnings. Later on this week, the main event, of course, is Nvidia after the close on Wednesday. You'll also get Target that morning. Look out for that. Walmart on Thursday. This is a new one on the calendar, the swearing in of Kevin Warsh as Fed chair. That's coming on Friday from the White House, I believe.
From the White House. And the last time a new Fed chair was sworn in at the White House was Alan Greenspan in 1987. Normally they're sworn in at the Federal Reserve building, and then there's some sort of celebration announcement at the White House. But Trump's going full hog on this one. It's the party and the swearing in. The first time since Greenspan.
People going to complain about the optics of that. Kevin Warsh at the White House. alongside the president.
I was in the last cabinet meeting where the president said because of all the renovations that's happening when it comes to the Federal Reserve, maybe we're going to have to find a desk for Kevin Warsh here at the White House. I immediately looked at Susie Wiles to see if her face was just kind of like, oh my God, no.
The building they're in right now, the Federal Reserve, is a beautiful building already. Could have used that, but anyway. Futures right now on the S&P 500. Yeah, we'll move on. We're down by about 0.4% on the S&P 500 this morning. Crude pulling back just a little bit. Let's focus on that. Under surveillance this morning, delaying strikes against Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran. And we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal.
Here's the latest this morning. President Donald Trump calling off attacks against Iran in an effort to give Gulf allies more time to push for diplomacy. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Hey, John, good morning. Well, President Trump maintains that the risk of escalation is still very much on the table, as he went on in that post on Truth Social to say that he has told his national security team to be ready at, quote, a moment's notice for large-scale strikes. At this point, the White House has not detailed any of these plans, as President Trump has long threatened additional military action, while on the other hand has maintained that a diplomatic solution still remains viable. But I will point out that our analysts at Bloomberg Economics say that it is increasingly likely that the White House could revert to short and intense strikes in a bid to change the status quo, amid reporting that President Trump has been advised in recent weeks that limited strikes could help pressure Iran to reach a deal. Because the latest is both sides are rejecting the freshest counter proposals just yesterday, as Iran underscores that it doesn't want to discuss curbs on its nuclear program, and the U.S. says that the naval blockade isn't going anywhere. In fact, CENTCOM confirmed yesterday that it has so far redirected 85 commercial vessels in its attempts to secure the strait, which at this point remains effectively shut, and the administration is looking for ways to get more oil supply to the global market, moving just yesterday to issue this temporary waiver to allow for the sale of some Russian crude barrels already loaded onto tankers and at sea. John, in fact, a person familiar with the matter tells Bloomberg News that this 30-day general license could very likely be extended as the war in Iran drags on within the next month. Considering that we saw the last general license lapse, it's something to watch here as the administration faces this increased pressure when it comes to rein in higher fuel costs.
Tyler, there was also a report yesterday from an Iranian semi-official news outlet saying that part of the negotiations, the United States was even willing to lift sanctions on Iranian crude. Is that potentially one of the tools in the toolbox?
Well, at this point, Annmarie, we did hear from a White House official who said that that report from Iranian state media was false and that that was not going to be something on the table. It was interesting because it did come, of course, the same day that we saw the U.S. Treasury Secretary Scott Bessent urge G7 allies to ratchet up their sanctions when it comes to Iran. In terms of any other sanctions that we could be watching, as you well know, we were just in Asia. President Trump telling reporters on his way back on Air Force One that maybe he would be looking at easing some of the sanctions on Chinese oil refiners who import Iranian crude, though at this point we haven't gotten any further update on that. It is very clear, though, that the administration is looking for some other ways that they could tamp down when it comes to rising fuel costs. But so far, we haven't really seen recent moves. I mentioned last hour on this program that the White House is looking at asking Congress for this temporary suspension when it comes to the federal gas tax. Annmarie, I will also quickly mention that yesterday we got some other reporting from Iranian state media, including that the U.S.'s latest proposal did not include payments when it comes to war damages. That is also something that at the moment is being disputed by the White House.
Tyler Kendall with the latest in Washington. Tyler, stay close. Thank you. Henry Treyz of Veda Partners writing the U.S. and Iran could negotiate a narrow reopening of the strait while the thornier tax issues are sorted out. Military escalation remains distinctly possible. Henrietta joins us now for more. Henrietta, welcome to the programme first. And secondly, I want to pick up on that last line. I think it's really important. In markets, overwhelmingly, the consensus is this administration is committed to a diplomatic effort to end this war. and avoiding the resumption of hostilities. Do the events of that announcement in the last 24 hours reinforce that or highlight that maybe we were closer to a resumption of hostilities than many people believed?
I think there's actually a lot of confusion on the street. My inbox is constantly, what are your odds of military escalation? I don't think there's a lot of confidence in one direction or another about what the president is going to do here. And that's because he doesn't have any good options. The fact that Iran's neighboring countries are telling the president, per his own words, that this is not the time to escalate militarily is because they're the ones that are going to get retaliated against. And they don't want their energy outlets, their energy refiners to be the ones that are targeted, which President Trump understands because it'll drive inflation and gas prices even further. I thought your last guest was really interesting, and it's disturbing to hear that this is not a widespread problem when you're pointing to earnings from Exxon as a reason for good news. The Gulf is closed, the Strait is closed, and inflation continues to seep across the entire economy into wholesale data, into PPI data, and the Strait is the problem. So escalating and further incapacitating energy refiners in the entire region is only going to exacerbate the problem. So the president doesn't have a good choice here.
So, Henry, why do you think that the Strait at some point could be reopened while they negotiate other issues? If this is the one piece of leverage the regime has, don't they want to hold on to this as long as possible?
Exactly. And so I think, Annmarie, the way I think about it is that this would have to be the United States allowing for the movement of freight and ships through the Ayatollah. It always comes back to this fifth and final point that Iran always includes on its ask list, which is, I want to have the ability to control flow through the Strait, which means collecting a tax. And in my opinion, if you really think about it, it's pretty easy and painful, obviously politically, for the president to allow some transit through the Strait, at least clear the backlog of ships that are in there, maybe get some of the oil out that's locked in, get those poor souls that have been stuck there for 80 days out of there, and get the flow through. But you'd have to allow for Iran to continue coordinating, which, by the way, the insurers want. And Iran is generating its entire own insurance policy to get those guys through. So in comparison to a military escalation, it's theoretically easier. Diplomatically and tax policy-wise, it's a disaster.
Well, Henry, are you saying that the Strait could open with Iranians collecting a toll, or potentially the United States using the Fifth Fleet and just having naval escorts?
Well, the naval escorts are extraordinarily expensive. They let 2 ships through. Each one costs $10 million, and that's going to escalate. And obviously, the president called that off after 36 hours or something because the manpower cost and the risk was presumably too high. If it was effective, we'd still be doing it. We're not. And that's the problem with the military sortie from the United States side. So the path of least resistance, if you're more worried about military, manpower, loss of life, is to create a formalized route to go through that goes through the tax policy angle. It's from a human cost, less problematic.
Henrietta, appreciate your take. Thank you. Henrietta Treyz there of Veda Partners. On the options available to this White House right now, they're limited, which is why they've committed to the blockade. Because at the moment, that's the low-risk option for now, because you've got the inventories. But as you aggressively draw those inventories down and you start to get hiccups here, there and everywhere, that becomes a higher-risk option. And that's where things get more complicated.
It's why you see OFAC extending these waivers when it comes to Russian oil. They're willing to allow Russian crude hit the market because they don't have a lot of choices for some of their partners, especially in Asia and in Europe. It's going to be a very challenging environment. Right now, to Henrietta's point, the Strait of Hormuz, John, has an X account, so you can message them and pay them to get your vessel through.
That easy, right?
Yeah, with some Bitcoin. Yep.
Okay. All right. Brent crude this morning around 111. WTI around 108. Equity futures negative. We're down by about 1/3 of 1%. Up next, we'll get the latest on Home Depot with Drew Redding of Bloomberg Intelligence. Hi from New York City. Welcome back to the program. Bramo on tour today. She's up in Boston. She'll be catching up with everyone over at JP Morgan at their tech conference. Coming up a little bit later, look out for this conversation with the Liberty Media CEO. Coming up a little bit later with Derek Chang. That's happening in the next hour. Stacked hour In about 60 minutes' time, we'll also catch up with the central bank governors of France and of Germany. So a read on the ECB. Ollie Krug on the ground at the G7, bringing you the latest from that a little bit later this morning. For the week ahead, this is how things are stacked up. We had Home Depot earnings a little bit earlier on this morning, sales falling slightly short. Stock's not been hammered. That's interesting. Later in the week, we'll hear from Target. We'll hear from Walmart. We'll also hear from Nvidia. That is the big earnings report for the week, given its massive contribution to the S&P 500 and to the Nasdaq. And then later in the week, we mentioned this earlier in the program, Kevin Walsh, Fed chair, sworn in on Friday, entering a really, really complex moment for any central bank anywhere, particularly for this Federal Reserve. Unclear what his reaction function is. Want some clarity on that. We do know the committee is incredibly divided at a time where inflation has picked up to multi-year highs, driven by this massive move we've seen in energy over the last few months.
Cameron Dawson was talking about, is this going to be potentially one of the first Fed chairs that comes to a meeting and dissents? Remember, he is taking Steve Myron's very dovish spot. So he might have to, assert himself in that way. I do think it is interesting, though. First, it was the Treasury Secretary, and then it was the president of this Fortune magazine. It wasn't a full-blown, I'm going to give Kevin as much space as he needs, but it was a sense that you might have to wait to see the figures to after the war is over. Basically, considering the fact that we are seeing a higher inflation environment with higher energy prices, potentially cannot come in and cut rates immediately.
I mentioned this quote from Jim McCormick over at Citi earlier on this morning. I see markets underpricing the risk of a Fed rate hike starting this year, not next year, but this year. And I think many of us, including myself, struggle to internalise that. I mentioned this yesterday. We heard from Neil Kashkari. He dissented against the language in the statement. And when he talked about why, he talked about the financial conditions tightening somewhat so they wouldn't have to do more further down the road. And my translation of that was ultimately, if you change the communication of the Fed, if you tighten financial conditions up somewhat, you get that done, you won't actually need to hike further down the road. So even the dissenters to the language on the easing bias in the statement right now, I don't see them as inclined to wanting to hike anytime soon.
No, but they want to set the bar and make sure that inflation doesn't run away from them. I mean, when you talk about an individual coming out and saying potential is going to be a hike, which some of the banks and analysts are starting to see this year, did you see Steve Auth, how he responded to when I said, can stocks continue to where you think they're going? That story persists if we have a rate hike. And he says, whoa, I don't even think there's going to be a rate hike. And that is a loaded question. It's so interesting right now. The debate is so different and robust. Citi yesterday, Veronica Clark is still expecting, her and the team, 3 cuts this year, while individuals are starting to price in a potential hike.
Let's start with the bond market then. 2s, 10s, 30s, and check out 2s first. Yields elevated by 3 basis points. You'll notice the yield here is still north of 4%, close to 4.1%. That is quite some way away from the policy rate on the Fed funds. Now, this is important because the gap has opened up, and this is why people are talking about the prospect or the risk of a rate hike in the year to come. On the 10-year, further out along the curve, north of 460, we've seen that over the last couple of days now, up another 2 basis points so far this morning. And on 30s, up about 2 basis points on the 30-year to around 5.15 yields at the long end of the curve at multi-decade highs. In Japan, at record highs on certain maturities. In the UK, numbers we haven't seen for almost 20 years.
It's not just a problem in the United States, although this would be a problem screen for the Treasury Secretary. Remember, he wanted 3% of the 10-year yield, Jonathan, when he came in. That was his hope and ambition. This is a global problem, and this is something that is actually going to be dominating the G7 finance ministers meeting happening right now in Paris. We already heard from the French finance minister who said, this is a problem. Energy costs going up, it's inflation. Potentially there's going to be a little bit of a drag on growth. This has a stagflationary fear.
That's the bond market move. Equities this morning down by about 1/3 on the S&P 500. Slightly lighter, negative across equity markets today on the S&P, on the Nasdaq, on the Russell. On the Russell this morning, we're down by 0.5. Just to round things out for you, to check out commodities, Brent and WTI. Brent's down by about 1%, but still holding on to 110. Call it 111. On WTI crude, 108. We're down about 1/3% on the session so far. On our radar this morning, President Donald Trump delaying strikes on Iran.
Well, other countries have come to me and they've said we were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, because we've had very big discussions with Iran, and we'll see what they amount to.
While there has been no immediate confirmation from Tehran of renewed talks, President Trump saying the countries are very close to reaching a deal.
But how many times have we heard that? I mean, I spoke to the president weeks ago when I called him and he said they're desperate to make a deal. Right now, when you get the readouts from the Iranians and the White House, they are still so far apart and on their red lines. And neither side is moving inwards, which is why the president talks about the fact that he could still go back to strikes. What I find so interesting about this truth yesterday is that no one was planning for a strike. And the president came out and said, I'm not doing one, which is why it feels like it's verbal intervention. And for the oil market, it's working. And Kit Juke says the market buys taco more than nacho. Taco, we know Trump always chickens out. Nacho, not a chance Hermes opens.
Still trying to work out what came out of that meeting in China. You were in Beijing for it, trying to work out the details of what was agreed, if anything, with regards to what's happening in the Middle East. And, of course, the latest on Nvidia, the CEO, Jensen Huang, saying he expects China to open up its markets to imports of American AI chips. The CEO speaking with Bloomberg's Ed Ludlow following that visit to Beijing.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
China, of course, has yet to sign off on accepting Nvidia's H200 chips following the US green-lighting access, and that right now is the sticking point.
I spoke to sources about this. They're waiting on Beijing. The United States has allowed the H200s. Remember, this was a huge U-turn for the Trump administration when it comes to the H200s. First, they were banned. Then in January, they gave the green light. Then in March, there was a lot of talk about specific Chinese companies that went to Nvidia and said, look, we want to buy these chips, and then went back and said, oh, actually, we can't purchase them because the Chinese Communist Party, the government told us we're not allowed to. After this meeting, does potentially that open up? And that would be a big win for Nvidia.
The marketing around this AI story is absolutely dreadful right now. It's something they all need to address. I'm sure you've seen some of the scenes from over the weekend with some of these commencement speeches at various colleges around the United States, and some of the individuals delivering those speeches getting booed every time they mentioned AI. Why? Because of language like this. Standard Chartered slashing more than 15% of its workforce leaning into AI. The CEO, Bill Winters, saying the technology will replace, wait for it, lower value human capital.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
The job cuts would take shape by the year 2030. Interestingly, with this announcement, the stock is lower in London trading. We're down by 0.8%. I can't think of a clumsier way to talk about this. That is not the way to talk about this, and I hope the lesson is learned in the years to come.
Well, as I said in the last hour, maybe you should have asked AI. So I asked Google Gemini, what is a better way to phrase this? Google Gemini, first word, oof. That original phrase is a textbook example of corporate speak gone wrong. Calling human beings lower value human capital and comparing them directly to investment capital sounds incredibly cold, robotic, and devaluing. Maybe before the next time a CEO goes out, or they go out and give a commencement speech or speak to shareholders or their company and their employees about AI taking over people's jobs, they should ask AI how they should deliver that message.
I think it's fair to say this is why some of those commencement speakers right now are getting booed.
Absolutely.
Off some of these stages. Looking at some of the data we're getting for the consumer, big week for retailers. We heard from Home Depot a little bit earlier on, the company missing expectations, pointing to high borrowing costs and slower consumer spending. Home Depot CFO Richard McPhail telling us here at Bloomberg, shoppers continue to defer large projects, telling us they have a higher degree of uncertainty. Drew Renning of Bloomberg Intelligence joins us now for more. Drew, welcome to the programme. It's not as if the bar was particularly high for these companies. We knew things were going to be difficult. How difficult were they in the last quarter?
Yes, it was a relatively neutral print for Home Depot. They had a slight miss on comparable store sales. But as you mentioned, coming into the quarter, expectations weren't all that high. The stock's down over 20% since mid-February. I think the more important thing and what investors will latch onto is the fact that they maintained their guidance for the full year despite these choppy macro conditions. Now, their guidance did assume that sales would be either flat to up 2%, so I think they did provide themselves with a little bit of wiggle room to kind of see how this macro ultimately shakes out. So I don't necessarily think we've seen the impact yet of the recent inflation and heightened consumer uncertainty. So we do think that there could be some risk through the remainder of the year.
Drew, that's the cyclical backdrop. There's also just this massive structural problem with interest rates because of what happened with the pandemic. Within the space of like 12 months, we had record low interest rates and then interest rates at multi-decade highs. So if you got that mortgage at the right time, you've still got it. And you certainly don't want to cycle out of that into what we get in the market right now, which is something closer to, say, 6%. Drew, do they have to think about this just being a longer-term structural problem that people just aren't going to be moving until that's addressed? And I don't see any solution for it at the moment.
Yeah, it's certainly one of the biggest headwinds to increased housing turnover. Somewhere around 70% of outstanding mortgages are below 5%. And without a whole lot of labor market stress, there's not a whole lot of incentive people being forced to move from their homes. You know, housing turnover right now is about 20% below normalized levels. We know that movers tend to spend more on home improvement spending. You know, so we think that the existing home market continues to bounce along the bottom. We don't necessarily see it as a headwind to home improvement retailers at this point, but the catalyst just hasn't come yet.
Drew, what's going on with the tariff refunds? I know Home Depot signed up for them. Are they going to get some of this money back?
So I think they mentioned that they have signed up for them. They have got some of them back already, but I think the CFO had mentioned that it's not going to have a meaningful impact for them.
How challenging has it been for the C-suite? They dealt with tariff last year. They're dealing with high mortgage prices, a housing crisis really in this country, and now potentially consumers just on edge because of everything going on with higher inflation and conflicts around the world.
Yeah, it's really been a perfect storm against the home improvement retail industry. I think one of the main things you highlighted, and it's what we continue to hear across the housing landscape, is just the elevated uncertainty, which is causing consumers to scale back spending, particularly on big ticket projects, which was mentioned by Home Depot. The other thing to keep in mind, with rates where they are, you're tending to see less spending on those big ticket projects because they're typically financed. So think of things like large-scale kitchen remodels, bathroom remodels, flooring, window projects. Those are all things that really haven't come back, and that's what you need to see in order to get the next leg of growth.
It costs a lot of money, that's for sure. Drew, it's good to see you. Thank you, sir. Drew Renning of Bloomberg Intelligence. Stock slightly lower. Bar was pretty low for this company. Name was down by some 13% year to date. Following last year's losses, that stock was down something like 10, 11%. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Meta is cutting jobs and reassigning 7,000 workers to new roles related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. SpaceX could make its trading debut as early as this week. Elon Musk saying the IPO is coming pretty soon as it seeks to raise as much as $75 billion on a valuation of more than $2 trillion. That would make it the largest IPO in the history of capital markets. New York City Mayor Zohran Mamdani is set to hold meetings with JP Morgan CEO Jamie Dimon and Goldman Sachs CEO David Solomon. This as wealthy New Yorkers and Wall Street push back on the mayor's proposals for higher taxes on the rich. And that is your Bloomberg Brief. John.
Vonnie, thank you. I wish we'd just say employers. I keep reading these stories about the billionaire class, just employers. The mayor today is meeting some of the biggest employers of people in this city. That's the headline.
Yes,
JP
Morgan
that's
alone.
News is shocking.
Yes, because this was a mayor who didn't want to engage with the biggest employers of this city. JP Morgan alone has more than 24,000 employees who work in New York City. And more broadly, according to our statistics, Wall Street accounted for basically 20% of New York State's tax revenue. So meeting with the biggest employers and also the biggest revenue generators when you look at your budget.
The fact that's even a story is just ridiculous. Right?
It's sad, actually.
It's really sad.
All these meetings should have been going on. I think there was maybe one ahead of the election.
At least they're actually happening, unlike under de Blasio, where these kind of things didn't happen at all, which was also ridiculous. Up next on the programme, testing consumer resilience.
Consumers are making difficult choices based on where prices are, but we haven't seen the consumer stop spending. Begrudgingly, the consumer has held on to their spending trends.
Up next, we'll catch up with Michelle Meyer of Mastercard from New York City. You're watching Bloomberg TV. There is a weight to this tape this morning. We're down again by 0.4% on the S&P. We're down by 0.75% on the Nasdaq 100. We're still elevated in the bond market. Yields on 2s, 10s and 30s higher this morning by a few basis points, up 2 on 10s to 461. Is this a problem? Mike Wilson of Morgan Stanley is constructive on this equity market, but on the bond market, he said this: we may need to see a more durable resolution to the conflict in the Middle East before yields fall. If bond vol rises with rising back-end rates, we would expect the first meaningful correction in equity prices since markets bottomed at the end of March. Mike Wilson of Morgan Stanley to kick off this week.
And the problem right now is when you have the president coming out and saying he's holding off on strikes that no one knew were planned because of what the Gulf partners have said to him. Is that a durable solution? No. We've been here multiple times. This conflict continues. We're in paralysis. And that is why maybe the oil market is looking at this and taking it as a signal, but not so much the equity and bond market.
Crude still elevated, slight pullback, as Annmarie indicated, but still elevated around 111 on Brent, WTI around 108. What does it mean for this economy? Under surveillance this morning, testing consumer resilience.
Consumers are making difficult choices based on where prices are, but there hasn't been demand destruction. And you're continuing to see consumers spend on services. You're seeing things like durable goods slow down, but we haven't seen the consumer stop spending. Begrudgingly, the consumer has held on to their spending trends.
So here's the latest this morning. A busy week of retail earnings continues. Target tomorrow, ahead of Walmart on Thursday. Michelle Meyer of the Mastercard Economics Institute writing consumer spending remains resilient. With some reallocation, inflation pressures remain concentrated in energy and in airfares. Michelle joins us now for more. Michelle, good morning.
Good morning.
Good to see you. You've seen these kind of energy shocks before. We've seen them recently a couple of times. How different are the spending patterns now compared to, say, then?
I mean, so one common theme is, of course, consumers are spending more at the pump. That's a given because energy prices are higher, and that's a necessity. So we're seeing spending on fuel and convenience run up about 20% positive on a year-over-year basis. Historically, when energy prices rise and remain elevated, you do see consumers start to reallocate their basket of spend, and durable goods will be more vulnerable, particularly things like autos that are directly related to gas prices, but even the larger appliances that are bigger ticket items. And then sometimes you'll see things like discretionary services start to slow down. What's interesting about today is that you are not seeing the shift in discretionary services. For example, restaurant spending is remaining very steady, very solid. And I think that says a lot about the consumer's desire to continue to engage.
Do you think we're running on fumes? What's this backed up by?
It's backed up by the labor market. I don't think it's fumes. If you see the last few jobs reports, it's obviously very volatile, but we are still seeing job creation. The unemployment rate is at 4.3%. That's a solid labor market, all things considered. So yes, we can debate how much labor supply there is out there, what the right break-even rate is for jobs. But when you look at an unemployment rate of 4.3% and very low unemployment insurance or jobless claims, it's supportive for the consumer.
We're about to have Memorial Day weekend. AAA is talking about highest gasoline prices in 4 years, but still record numbers are going to hit the road. Do you see consumers still having the money and the appetite to go travel?
Yeah, so we just published a big report called the Travel Equation, where we look through the three big forces that are driving travel. It's macro, it's machines, which is AI, and it's personal motivations, which is always a big factor that drives people's decision to travel. And it seems like, yes, travel is still happening. It's a reorientation of travel for sure. So depending on how much consumers can afford, they may decide to drive less, drive differently, go somewhere else, but they're going. And it's the same thing with air travel. So of course, there's the conflict in the Middle East, there's higher jet fuel prices, some of that is being passed on through higher airfare. And consumers are going to take that into account. But they're going to look for places to go and ways to still find value in travel. So this reorientation is considerable, and we see it.
They're traveling, but are you basically saying the conflict in Iran is dictating potentially where they're going, their destination?
Well, it's an important factor from a safety perspective, from an availability of flights, from a connectivity perspective, and a cost. So one of the things that we found very clearly in our research is the influence of AI to help consumers find value and find those places to go. So we were able to look at two different cohorts of consumers, one that utilizes AI subscriptions and one that doesn't. And you see different travel trends based off of those cohorts.
In what way? What are they doing? What are they finding out?
So the first thing, those that use AI subscriptions have a greater share of wallet towards travel, which is interesting. It just shows that maybe it's a younger cohort, more inclined to utilize their purchasing power. But you also see these off the beaten path type of destinations, particularly throughout Europe, where it's a very high share of AI subscribers that are the tourists in the destination. So Leipzig, Germany, which is a big music city, a third of tourists from the US are AI subscribers.
Wow.
And that's because they were taken there, or that's just a correlation? Correlation or causation? I'm just trying to understand.
That's very hard. It's a good question. It's hard to know if it's correlation. Are those AI subscribers more likely to have gone there regardless,
right,
or are they finding those destinations? I think it's got to be part of the latter. You're identifying new places to go that have more value, that are a little bit unknown.
Asking for a friend, where else in Europe?
Yeah. Read the report. There's a lot of good locations.
I've read the report. FX a big factor in all of this as well.
FX matters too, yeah, of
Yeah,
course.
I've always wondered. In London, I was very sensitive to that. I'd check different places and maybe decide based on what the foreign exchange market was doing. Is that becoming a bigger thing stateside?
That's very savvy of you. But yes, I think it matters more for the emerging markets. Particularly, we see a lot of that FX volatility influencing where people travel in Latin America.
Michelle, it's good to see you. Thank you. Michelle Meyer of Mastercard. Consumers are still spending. They're not running on fumes. It's backed up by a labour market that has cracks, let's put it that way, but still it's pretty decent.
But I do think it's interesting that because of jet fuel costs, because of other issues, potentially travelers are looking into peak travel season is going to be this summer, and maybe they're changing their destination. I didn't realize also AI was helping you find some great deals.
Didn't know that either. This, of course, is the big test for this Federal Reserve. Consumer price tolerance. Will they absorb these price hikes? And if they do, where does it leave this Federal Reserve?
It's going to be a challenging one, especially given Kevin Warsh is going to be sworn in this Friday, an individual that was looking pretty dovish coming in, and now potentially from Scott Bessent and the president himself, give me a little bit of cover. Potentially he's going to have to remain on hold for longer.
These particular ceremonies can get a little bit awkward. Do you remember the one with Yellen and President Obama? Do you remember that one? It was a little bit awkward because that wasn't really the person he wanted to be running the Federal Reserve. He wanted Larry Summers.
Yeah, he wanted someone else. Larry Summers wanted Larry Summers, too.
And Summers wanted Summers. I think Summers always wants Summers, doesn't he?
But President Obama wanted Larry Summers, but he ended up with Janet Yellen. So right. I don't think this one's going to be awkward, though, because the president has known Kevin Warsh for years.
No, I don't. This is the guy he wanted, obviously.
Yes, and also has a family relationship there. I mean, he's friends with Kevin Warsh's father-in-law. So I think the president is going to be so excited at this ceremony.
I think Kevin Warsh is hopeful that the president doesn't say anything about where he thinks rates should be.
Yes.
And at least the volumes come down on that a touch.
I think Kevin Warsh is hoping it is going to be strictly a signing ceremony and not an event where journalists can come in and ask questions.
Best of luck to him. Looking forward to that signing ceremony. That oath that's going to be taken a little bit later this week. Coming up, Ajay Rajadaksha of Barclays, Liberty Media CEO Derek Chang, and we'll catch up with the central bank governors of both France and Germany. Look out for that a little bit later in the next hour on Bloomberg Surveillance.
We're seeing a bifurcated S&P 500 for sure.
The AI theme is best expressed right now in U.S. large cap growth stocks.
It's hard to know who's in a bubble.
We are seeing a weakening in the overall AI story.
If it is in fact a bubble, nobody knows when it will pop.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action scores look like this, pulling further back from all-time highs on the S&P 500, down on Friday, down on Monday, down Tuesday morning so far by 0.5%, negative 0.8 on the Nasdaq. The bond market not helping. Yields higher across the curve, up by almost 4 basis points now at the front end, approaching 4.1% on 10s, back through 460 on 30s. Hello 515. Yields up by close to 3 basis points at the long end of the curve. Again, a number we haven't seen going back to 2007 on a closing basis. In the commodity market, crude is okay. Today it's well behaved, but it's not helping out bonds and that's not helping out stocks. Crude around 111 on Brent, WTI around 108.
Crude may be taking on some of that verbal intervention from the White House. The president said he had planned a strike. He pulled back on it, calling it off at least for the next few days. And this was at the behest of Arab allies. And he says that negotiations are ongoing. But we've been here so many times. So some parts of the market are taking it that it's real, and some others are kind of brushing it off until they see something more tangible. On top of that, though, the oil market is probably going to be helped by an OFAC license. That Russian crude gets another 30 days, so you can continue to buy Russian oil that's at sea. Potentially, though, it does show that this administration is going to be looking for ways to try to add more barrels to the market because we are going to peak driving season and things may get tense domestically.
That move in energy is exposing weakness in fixed income, underlying weakness that hasn't been addressed for quite a while. You get a move in energy, which drives CPI to multi-year highs, which exposes limited fiscal space in certain governments across the West, which highlights leadership issues in places like the UK and elsewhere. And this is why the G7 has got language like this morning. Policy responses to the war should be fiscally responsible. I'm not sure they have any choice because this bond market is prepared to push back. And especially for Europe, it's very challenging. So remember, they're off the heels of a different energy crisis when Russia invaded Ukraine. So this is why they've been here before, and it's very concerning for them. When you look at what's going on in the bond market, you say that where we are for 30-year yields, we haven't been since 2007. Barclays strategists are saying we could push 5.5%, where we haven't been since 2004. And BlackRock research is saying stay away from developed market government bonds and just go into equities. Yields this morning up across the curve. Coming up this hour, Ajay Rajadaksa of Barclays with stocks looking to snap a two-day slide. Liberty Media CEO Derek Chang with the Formula One season in full swing. And Jay Goldberg of Seaport with a street low price target on Nvidia. We begin this hour with stocks drifting lower and bond yields remaining near multi-decade highs. Ajay Rajadaksa of Barclays writing both stocks and bonds look unappealing at this point. We expect the risk rally to now take a step back. Ajay joins us now for more. Ajay, good morning. Good to see you.
Good morning.
I think we need to catch up on where we were. You were very constructive on the equity market. We caught up recently in the last couple of weeks and you said it's not that we didn't think the situation in the Middle East mattered. We just didn't think it mattered yet. We at the yet now. We at that point right now.
Yes, we do. I think we are at that point. We are now getting to a point where every week the world is drawing down more rapidly on oil inventories. And the bond move in particular, remember when I was here 3 weeks ago, right? You pressed me for an answer on what I would buy. And I basically went hamana. You know, I couldn't have an answer. That's pretty much where I am still. I think the bond move is not something you get in the middle of. It's real and it will last, I worry.
Well, let's pick up on the curve right now. Let's go through these numbers. 460 on 10s, 5% on 30s. We've seen 460, these kind of levels, a few times in the last few years. Typically, it becomes self-limiting. You get to a point and then people worry about growth. People start buying bonds again. This time, I've seen a variety of research point to this belief that maybe this part of the market, long end of the curve, maybe pushing out to 30s, has become unhinged or untethered. Are you worried about the same thing?
I think at the very least, I'm worried about a drift higher in longer rates. And it's for the reasons you said, Jonathan. So first is we do have a catalyst in terms of an inflation shock coming from oil continuing to last high for longer. But second, these are the sins of years and years starting to pile up. I mean, it's not just the United States. Across the West, we've been spending money like a drunken sailor on shore leave for at least a decade. And that's coming back to haunt us now.
We've lost our anchors. It used to be the German debt market, it used to be JGBs. You could get away doing funny stuff because you had these two dominant markets just holding down global yields. They've gone away. What's the anchor now for fixed income?
I don't know. I think the US is an easier answer because there is going to be a clearing price at which private investors come in. We do have the privilege of being the reserve currency, weaker as it is in recent years. Believe it or not, I worry more about countries like France, like the United Kingdom, where there's a bad mix of both politics and economics. In both countries, in the United Kingdom, you're talking about 4 prime ministers in 4 years. You might get a 5th now. On the French side, you've had 5 prime ministers in the last 2.5 years. That is not coherent policy.
When it comes to this bond market, potentially we saw last year the bond market be the reason the president had an about face when it comes to tariffs. Do you think this is the bond market pushing back potentially on this conflict in Iran?
I think at the very least, the conflict in Iran is now starting to be a catalyst. Because one of the things that has happened, Annmarie, is everyone has pushed up their 2026 averages for oil. as every week passes, people are just marking to market and saying, look, for example, when I came here last, I thought oil would average $85 to $90 a barrel. I think we'll now average $100 a barrel.
For all of 2026.
For all of 26. And remember, the first 2 months weigh against that argument, right? Because we ran at $70. So this is a pretty big problem. It is a pretty big energy shock, and the bond market is reacting to that.
And what does this mean for equities, higher energy prices?
So I have hesitated going short equities just because the power of earnings has scared me. And then you had momentum. But I think we are getting very, very close to the point. I mean, you asked me to pick a side right now, I would not own equities here.
Well, that's stocks versus bonds. You say you don't pick a side.
Cash.
You mean short versus long?
It's unfortunately a non-answer, Jonathan, but there's nothing that is attractive.
No, I understand. When was the last time you were in this position?
Not for a long time. Not for a long time.
Knowing you for a while, it feels like this has been a while. When was the last time? Can you think back to it? What were the conditions then that got you to this place? Does this feel unique?
At the absolute bottoms of COVID, where I was massively wrong, just because I didn't know where, whether the system was going to work, where the next policy reaction was coming from. This is not remotely like that in terms of magnitude. I don't mean to imply that, but I mean, the earnings story is so strong that it's very hard to go decisively in the other direction. The bond yield move is significant, but it's still not appealing enough. No one's making any progress on the fiscal side. There's no political will to do anything. And you're about to get an inflation shock. I just don't know where to go.
Well, let's stay with the bond side of things. This is where things are confusing for a lot of people for a whole host of reasons, and we can go through them. One is energy. The other is limited fiscal space. The other is weak leadership. Hello, UK. We talked about that. France as well. That's been a problem for a long, long time. There's another issue in the mix as well, which needs to be addressed. Let's isolate that and talk about it. And that's the reaction function at the Federal Reserve. And it's not clear right now what Kevin Walsh is going to decide to do, look to anchor. When you first saw this shock, Chairman Powell came out and tried to anchor inflation expectations, planted that flag almost straight away in the news conference. You could see that was where the emphasis was. Do you know what the emphasis will be next month at the next Fed meeting?
Well, I should start by saying the Fed, if you look at financial markets, has very clearly not lost inflation credibility. So if you look at five-year inflation break-evens, they are still pricing, and you look through the next 5 years to 5 years beyond, they are pricing in 2% on core inflation, literally. Okay, so the starting point on a credibility standpoint is good. But I don't for a minute see how the Fed can deliver rate cuts this year, genuinely, regardless of what the motivation might have been, behind the decision to nominate Chair Walsh. I'm not even saying that was the reason. I think they're just going to have to wait it out. Years ago, Governor Waller told me something that has struck in my mind. He said, look, base effects are a central banker's best friend. So when you get a supply shock, which is the shock that you're getting right now on the oil front, right? The Fed can't do anything by hiking interest rates to make oil flow more freely. It cannot do anything by cutting interest rates to, you're not supposed to cushion the shock through monetary policy. You just sit on the sidelines, and that's what they're going to do. So I don't think the Fed is going to be a driver of longer yields going even further here. But the starting point is just very poor. I mean, that's all there is to it.
You don't see a cut, but you don't see a hike either.
I do not see a hike.
Where will the next move be once the war is over?
I think the war over is actually not a catalyst for a move. Let's start with that. So for the rest of 2026, I think the Fed sits squarely on the sidelines. Say the war is over, they will take their cue from data. And one of the problems for both the front end and the bond market as a whole, Annmarie, has been that the US economy has held up. It has to, you saw retail sales last week, for example, right? The consumer savings rate is very low. We are not creating any net jobs to speak of. It doesn't matter. The consumer keeps spending. So one of the best things that could happen from a macro standpoint, near term, strange as it sounds, to prevent this one-way move in bonds, is for data to weaken. If that doesn't happen, I think the Fed stays on the sidelines. But more importantly, the bond move doesn't stop.
10's at 5. Would I get you interested?
Yes. I think another 40, 45 basis points would get me.
That's the number for you.
That is the number for me. And not because I think things magically improve, but there is a clearing price at which private investors come in. I don't know how to solve the equation for economies like France, for example, where last year inflation ran at 5%, the deficit ran at 5%, and nominal growth ran below 2%. That's the circle that I have a very, very hard time squaring. I don't think you had a bond crisis this year, Jonathan, because debt management offices still have something up their sleeve. They can keep issuing lower coupons in the long end, and they can stave it off. But every time you get a headline, it's going to be in the upward.
But this is the problem in places like the UK. I struggle with the same story.
Yeah.
You could shorten up duration as much as you like, but ultimately, if you're facing an inflation shock and your central bank might respond to it, you've got problems.
I agree. I mean, do you remember last July where there was a lot of news in the UK press about how Chancellor Reeves was seen getting emotional in Parliament? The more significant part that week, if you remember, was that Labour, with a 160-seat majority in a 650-seat Parliament, wanted to pass a small cut to the winter fuel allowance and faced an open parliamentary revolt. There is no political will anywhere.
This is where I'm really struggling with places like the UK. And why I said yesterday on the programme, I'm not really too interested right now in who leads the government, because you're not going to see the changes required to get this country, this economy on a better trajectory unless you see massive pressure coming from fixed income. That spells out a very dreadful story for the future
I think
of the
you
UK
might actually
finances.
need to get a shock. Hopefully it doesn't require that, but
things have to get worse.
There is a chance that the only way that policy... And, you know, it didn't used to be this way. I'm completely dating myself. In 2011, US Congress got so worked up, they established a bipartisan commission called Erskine-Bowles because they thought US debt to GDP was too high. You know what our debt to GDP was then? 60%. We are over 100 and going to 120 and no one cares.
I remember that.
It's gone very quiet in the US, hasn't it? But we've got that privileged stateside that the UK doesn't seem to have at the moment.
Yeah, but even so, you can't run 6.5% deficits indefinitely without the market.
With unemployment close to 4.
With unemployment close to 4.
I agree. Ajay, could talk to you all day. It's good to see you. Thank you, sir. Ajay Rajadaksha there of Barclays on this fixed income market. 10s at 5, it gets interesting. 10s right now at 460, not so much apparently. Yields higher by just 2 basis points on a session so far. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump calling off planned strikes, he says, on Iran today. Trump saying Gulf allies asked for more time to seek a diplomatic resolution, adding the US remains prepared to attack if an acceptable deal isn't reached. Nvidia expects China will eventually allow AI chips to be imported from the US.
My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
Nvidia CEO Jensen Huang telling Bloomberg he didn't discuss the company's H200 chips during his trip to China with President Trump. Nvidia reports earnings after the bell tomorrow. And it's going to be a hot one here in New York City. The National Weather Service issuing a heat advisory for the city and New Jersey, with temperatures expected to soar well into the 90s. Late day thunderstorms on Wednesday are expected to bring temperatures right down. And that is your Bloomberg brief. John.
Vonnie, thank you. I live for it. The winter's so long in the northeast.
I know, it's time for the beach.
The days are so dark. But the promise of summer just keeps you alive, doesn't it?
And you can blade there for $95.
Unlike the UK.
Oh, no,
when the winter's
UK.
so dark and the winter's so long, and there is no promise of summer whatsoever apart from maybe a few weeks in August and July.
Basically 1 week. There's one always amazing
And then
week.
September. It's amazing. And London, honestly, nowhere better when the sun is shining.
Yeah.
But it's just rare. And
it
that's
lasts
the
like
problem.
5 days and that's it.
OK. Futures this morning, negative by 0.4%. Up next, we'll get you some morning calls, plus Liberty Media CEO Derek Chang on F1, MotoGP and Live Nation.
We were seeing certain extremes in some of this trading. And you also saw this narrowness really not be consistent with an overall new high-end market. So it made this fragile. We think it is a pause, but at the end of the day, when you have an over 18% weight in a cohort of names that went vertically up, a simple correction in those names back to trend could be damaging for the overall market cap weighted index.
That was Cameron Dawson of NewEdge Wealth on this equity market a little bit earlier on this morning. Your equity market right now negative by some 0.4%. On the Nasdaq down by 0.75%, call it 0.8%. Going into the cash open 1 hour and 12 minutes away. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on SanDisk to 2025, seeing persistently strong storage demand and a highly favourable pricing environment. That stock struggled in the last 24 hours. It's down this morning by 3%. Your second call from Mizuho raising its price target on Micron to 800, seeing positive impacts from AI data centres on memory chip makers. That name also lower down by 2.4% this morning. And your third and final call from HSBC, raising its price target on Nvidia to $325, expecting a beat and a raise in the company's earnings report tomorrow after the close. That name is down by some 1%. Let's head back over to JP Morgan's annual Technology, Media and Communications Conference underway in Boston. Lisa standing by with another special guest. Hey, Lisa.
Hey, John. Thank you so much. I am here with Derek Chang. He is the CEO of Liberty Media, also sitting on the board of the Oversight, Liberty Media's subsidiary that oversees Live Nation. Derek, thank you so much for being here. Really appreciate it.
Lisa, thanks for having me.
So I want to start with the idea that everyone here is talking about scale, getting enough scale, merging up, particularly in the media space. You moved in the opposite direction last year, breaking up into a host of different entities. Can you talk about why you decided to do that?
Well, I think if you look at Liberty Media over its history, it's had a history of sort of expansion, contraction. You know, we kind of go with the flow a little bit depending on what the circumstances are and what the market is asking for and what we think that we should be doing for our shareholders. So I don't think in this particular moment it was a specific strategy of we're ultimately going on a trail of just sort of getting smaller. It was clarifying and simplifying the structures, and so delivering to shareholders sort of what assets they want in what places at this particular moment. But, you know, over time, we have had tracking stocks, we have spun out companies, and now we're sort of back to a more simplified structure. And it's really to provide that clarity for shareholders.
So you oversee your two main properties at Liberty Media are Formula One and MotoGP, which is relatively new in the U.S., very big in Europe and Southeast Asia. I'm just wondering how you're thinking about a media strategy. You just signed this 5-year deal with Apple in terms of streaming rights. Is it the same between streaming and legacy cable networks? Is it sort of all the same at this point when it comes to sports licensing?
Well, I think it still depends on what markets you're actually in. And so in a lot of markets like the U.S. at this point, the streamers have you just spoke about scale, a lot of scale. And I think that historically people have said, oh, you got to be on a broadcast network, otherwise you're not going to have the reach. I don't think that's true anymore. And I think the deal that we did with Apple basically has shown that is, for us, we've seen no real drop-off in terms of viewership, and in fact, engagement overall is higher than it was before in the early sort of going here, the first 3 or 4 races that we've had this year. And I think what that speaks to is streaming platforms certainly in the U.S. have reached a level of maturity and even beyond, you'd say. And you see it right now with sort of what's gone on at the NFL, their recent deals that they're doing. So clearly it's part of sort of mainstream viewing habits. And this whole concept, I think, that the knock on streaming was also you lose sort of the sampling effect. And I think what you see with our deal with Apple is that people sample in different ways. So you go into an Apple store, or you watch other content that's on Apple TV or Apple Music, or what they do with Apple Maps, which they did in the Miami race, where they sort of created an apps, integrated it into Apple Maps with stuff around the Miami race, and they had special content for that race. So you've got platforms now that, because of the technology they have, because of their sort of, in Apple's case, singular focus on Formula One, the ability to actually expand your audiences in different ways than you ever have.
Do you think that you're going to move to a Netflix type of model that you did with F1 when it comes to MotoGP in the U.S., where you have a TV series about it and you sort of broadcast it to popular consumption in a way to democratize exactly what it is?
Well, I think what you're going to see with MotoGP is a lot of what we did with Formula One. There will be similar applications of that. So the biggest thing for us with MotoGP is how do you take the sport, which at its core is a very pure sport and a huge, passionate fan base, and how do you expand that? How do you get more people engaged, whether it's in the U.S. or worldwide? And I think you do that by telling the story. And MotoGP has never really told that story. And you do that through riders, you do that through the action on the track, and you do that sort of in multiple ways, through content, through fan activation at races, through the licensing partners and the sponsorship partners that you have. But I do think the content piece of this is a very important part. Whether you do a show just like Drive to Survive, I don't know if that's necessarily going to happen because it's a different sport and you want to remain authentic to your fan base and to the fans that you're trying to attract. So we will figure out things that we can do in and around MotoGP that sort of creates the same impact and making it available and making it accessible to as broad a fan base as possible.
You also help to oversee Live Nation, the Live Nation investment through the Liberty Board. And I'm curious from your perspective, ticket prices are really expensive. Everyone talks about it. Everyone complains about it, that the inflation in ticket prices to go see events is incredibly high, and then they still go. How do you understand the inflation in ticket prices, whether it's World Cup and what's going on there, or whether it's basketball at Madison Square Garden, and understand what's the right pricing? How do you do that strategy?
Well, the reality is it is simple supply and demand, right? And so I think what you're seeing is there's huge demand for live entertainment, live events. And, you know, I see this through the Formula One lens where our Paddock Club is, for the most part, sold out through the rest of the year here already.
The high-end club.
That's the high-end, you know, tickets and hospitality that we offer. And I think there's just so much demand for these sorts of experiences that the reality is you could probably, you know, create multiples of availability and it's still going to sell. I don't know about, you know, the specific ticket pricing strategy for those, but I think ultimately what you're speaking to is there's just this demand, this pent-up demand for live entertainment that you know you continue to see, despite the fact that there are a lot of different things that people can go to. But I think it's the allure of that and the appeal. And for different people, it's different reasons, right? Some people go specifically for the racing. Some people go for the racing and for the food. Some people go for the racing and for the celebrities. Whatever it is, there's this just attraction to it. And I think we're bringing that to the fans.
Derek Chang, thank you so much for being with us. Derek Chang, CEO of Liberty Media. See that, John? You're talking about how expensive the World Cup tickets are, and maybe it's just that the food is really, really good if you go to the right seats and you get to be part of a great experience.
I'm doubtful of that. Bramo, thank you. Appreciate it. Looking forward to 6 weeks of complaining about ticket prices at a World Cup. Coming up on the programme, a pair of central bank governors. Check this out. This is going to be fantastic. We will hear from the French central bank governor and the German central bank governor as well, from the G7 on the future of rate policy at the European Central Bank. That conversation just around the corner. Plus, Danny is going to have some morning movers for you. Memory stocks falling as the chip slump continues. The opening bell about 60 minutes away. Equities pulling back by 0.4% on the S&P. We're down by 0.8 on the Nasdaq. Some jitters in tech. Could talk about that a little bit later. Danny's going to have some single names for you. For the S&P 500, also some headwinds coming from the bond market. Fixed income yields drifting higher again this morning. 10s at the moment around 462. 30s at around 515, and 2s still comfortably above the policy rate at the Federal Reserve. The 2-year yield around 4.1%. As we count down to that cash open, let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Starting with earnings in apparel, Amer Sports doing very well today, up 3.6%. Their Solomon shoes, they're very popular. You can see them basically going everywhere, and so that supported their earnings along with their brand Arc'teryx. Interestingly, they said that people are buying full-priced items. They're not having to put things on sale, which is helping them against shares moving higher in the pre-market. Now, some of the jitters around tech that you mentioned, a lot of the AI stocks continue to sell off. The chip makers, after this huge run that they've been on, you look at SanDisk down 3%, Seagate down 3.5%, Micron down 2.5%. Part of that is just higher yields, a turn in risk sentiment, but also you had the Seagate CEO saying at that JP Morgan conference that Lisa is at that they can't meet all of the demand. They don't have enough capacity. It's maybe a good problem to have, but even so, the sector selling off. But one little piece of evidence that might show that this is something mechanical, this is taking profit and covering your shorts, is is what's happening in software. Because while AI has been selling off, the flip side of that are the best performers pre-market in the S&P 500 are software names. ServiceNow, one of the best large cap performers, up 5.3%. Workday, Salesforce, all of them are up around 2%. Again, no specific news tied to them, but maybe just the flip side of the AI sell-off, John.
One to watch going into the opening bout. Danny, thank you. Thank you for the update. Just had to double check that Miller is in the building today before I promote the show. Matt is here. Matthew Miller will be attending his own show at 9 a.m. Eastern Time in about 30 minutes' time alongside Danny Berger. So look out for that. They'll guide you into the opening bout. Let's talk about monetary policy, the future of monetary policy, and the pressure building on some central banks to maybe consider hiking interest rates. Perhaps the ECB will be the first, with two special guests. Our good friend Ollie Crook on the ground of the G7. He joins us now for more. Hey, Ollie.
Yeah, that's right, Jonathan. We're here at the G7 finance ministers meeting with central bank governors in Paris at the French finance ministry. The big question in the room, the effect of the war in Iran on inflation, on growth. And we're very lucky to be joined not by one, but by two ECB governing council members, the governor of the Banque de France, François Villeroy de Galhau, and the president of the Deutsche Bundesbank, Joachim Nagel. Thank you both for joining us today. Since you're the host, I'll begin with you, Monsieur de Galhau, and trying to get your assessment first of the conversation in the room among the G7 and what the sort of idea of collective action, what is appropriate at the G7 level to dampen the effect that we've seen from this war?
So first, as you are perhaps aware, this happened to be my last G7 meeting, and I was delighted to welcome my friend Joachim Nagel and all my colleagues from the G7. So I can compare through the last 11 years, and I can frankly say that this Paris G7 won a very good G7. We are in difficult circumstances. You mentioned them. But the discussion was lucid, without any complacency. It was a free discussion at the highest possible level, and it was a confident discussion. And we shared the analysis on global economies, we shared the will to reduce global imbalances, to address the negative consequences of the conflict in the Middle East. And for us central bankers, we are fully determined to bring inflation back to target.
And I'd like to get in, if you could share with us some of your joint analysis of that situation right now. The ECB has given us a framework by which to think about this, the base case, the adverse effect, the severe. I'd like to get both of your perspectives on where we lay on that in terms of the impact of this war.
Maybe before I come to this, I have to congratulate François as well. I think it was an excellent meeting, and you alluded to it. We were, let me say, outspoken in a way. We really recognized this is a delicate situation, and we had an open discussion. And so this was a very fruitful meeting here in Paris. Coming back to your question, where we are, I think this whole conflict started more or less 3 months ago. Now we know that this energy supply shock is more persistent. So we are moving away from our baseline scenario. And so this is, I guess, I believe, a fair description of where we are at the moment.
But does that mean that we are now in the adverse and severe scenario? How are you thinking about it? Because that's the framework the ECB has put out for us to think about.
It is, as always, we will take our decision on data. We will come together in June, and then we will have our decision based on data. But I alluded to it. There is it's a higher probability now that we are now away from that baseline scenario. That means that maybe we have to do something.
And one of the big questions is about the secondary effects and whether or not this inflation is spreading from just the energy, the headline level, to the broader core. What is your analysis of that at the moment?
Can I first insist on the fact that figures are very volatile if you look at financial markets. So we shouldn't focus on data points, but look at the trend. As Joachim just said, as this conflict is lasting for longer, we have to look at more structural, long-term consequences. To give two obvious examples, we discussed financial stability and the bonds market situation. We also have to accelerate our energy diversification and reducing the dependency of most of our countries, starting with Europe, from fossil energy. It's obvious, but let us not limit our response to an emergency answer. On the monetary answer, I think the data will matter more than a precise date. And this is focused on the second round effects.
So for the market's expectations, so they say that there's going to be 2 to 3 rate hikes from the ECB this year, beginning in June. Are you comfortable with that analysis? Do you find that that is a correct interpretation of what we've seen so far?
I guess it's not helpful to speculate about maybe the numbers or when do we what. I think this is not helpful. I think this meeting-to-meeting approach based on the data that we have on that meeting, this is the right way to do it. So we showed our commitment over the last 4 years. We hiked 10 times, we lowered 8 times, and we will show the same commitment when we're coming together for our next meeting.
You think of the French? Yeah.
Can I add on markets 2 things? We are not market-driven, we are data-driven, obviously. That said, through markets there is a tightening of financial conditions, and it already plays a role in fighting inflation threats. So we will see, and I think that this is the most important commitment. We showed it in the last 4 years, but European households, European firms can trust us, ECB, Bundesbank, Banque de France, to bring inflation back to target. And this is, believe me, the most important commitment.
And though you're not market-driven necessarily, the market can have bearing on the economy and how things develop. We've seen a move in the bond market recently. How do you interpret that move? You just spoke recently about, obviously, part of it is inflation expectation. You said part of it is political risk. What political risk?
Look, Sarah, first, it's a global phenomenon, and not only a European one, beyond the G7. And there are at least 3 explanations. First is global uncertainty, obviously, and political uncertainty in some jurisdictions. Some question about fiscal policies, and they must remain sound and sustainable. And third, let us be honest, fears of inflation. This is where of our commitment matters most.
And I think just to try to nail you down on this one point, on the question of inflation, do you find that it is currently still segregated to the energy sector? And if it is so, is there a world in which you look through it, this next rate decision, in the sense that it is just at the headline level?
So what I know from inflation and how inflation might develop, it's pretty much dependent on the duration of the shock. And I already said it, I alluded to it. The probability is rising then that we will see more inflation everywhere. And this is something we have to take into consideration, and we will do this in our next meeting.
And how much do you think the story on yields is not just about inflation, but also concerns in Europe that we're a bit stretched sort of fiscally? There isn't the firepower, because we look at the sort of fullness of what we've seen in financial markets, growth being dampened, inflation rising, while at the same time equity markets in the United States parabolic, and now yields rising, the bond market catching up. Does that not sort of hold some of the ingredients for sort of untidy unwind in financial markets? Does that concern you?
Well, I think it is not a comfortable situation, this is for sure. I think we, on the monetary policy side, we should be focused on our mandate, and this is price stability. And everyone has to take responsibility here. Is it fiscal? Is it our job? I think it is a delicate situation, but if everyone is taking the respective responsibility, then we can more or less calm markets.
If I can add 2 things. First, fiscal policy must remain sound. That means that there could be some measures to address the negative consequences for the most vulnerable in our countries. But these measures must be targeted, temporary, and tailored. We said it unanimously in the G7. And can I add another thing, if I compare with the US or some Asian jurisdiction? There is also in this jurisdiction a positive supply shock on artificial intelligence, AI. And it's really of the essence that Europe accelerate on its innovation and on its growth. This is about the Draghi and Letta agenda. We called for it together 18 months ago. And the present situation is not a reason less to focus on structural reform. It's a reason more to accelerate on innovation in Europe.
And I couldn't agree more. There's a lot we can do on the European side. We have to do our homework. Is it the savings and the investment union? Is it the banking union? We have so many things on our plate where we can do a lot to more or less diminish this whole uncertainty.
And in those conversations you were having with finance ministers from the monetary policy perspective, what advice did you give about fiscal policy in terms of not stoking the inflation side of the equation?
Triple T.
If I may,
can I add that the IMF was around the table, and they have an interesting tracker of the fiscal measures taken so far. I don't say that they are all fully compliant with the triple T, targeted, temporary, and tailored. But if you look at the magnitude is much more limited than 4 years ago. And this is welcome.
Well, gentlemen, thank you so much for your time. The governor of the Banque de France and the president of the Deutsche Bundesbank for joining us here at the sidelines of the G7 finance ministers and central bankers meeting here in Paris.
Ollie, thank you, buddy. Appreciate it. Thanks for all of that. Fantastic conversation on the European Central Bank. Two individuals well aware of the history of hawkish policy mistakes at the ECB. Then it was under Trichet going into the 2008 financial crisis. Also heading into the sovereign debt crisis in the Eurozone as well. Hiking interest rates in response to, guess what, a move in crude, particularly around 2008. And the jitters around the inflation outlook and the inflation mandate. The date's important here. The next meeting is June 11th. The two individuals now were talking about the duration of the shock. There's time here between now and then. I've got no idea where we'll be between now and then, where we'll be on June 11th. Communication's important here. And I would say that this is a communication exercise for these central bank governors right now. They want to commit to the idea that they'd be willing to hike interest rates if they need to. And that's important because what it achieves is a tightening of financial conditions, which helps to anchor inflation expectations. And you heard them say that themselves.
Yes.
That the markets right now is doing some of the work for them.
Right. And you heard that from Nagel. Maybe we have to do something in June. Maybe we have to do things in June. Everyone knows that June is going to be a live meeting. And just those words himself may help set the bar and anchor, as you say, those financial expectations. It's going to be an interesting time because, to your point, we don't know where we're going to be with energy prices, which is heavily impacting Europe right now, between now and June 11th.
Still a few weeks away, just a few weeks away. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Sandy fire in Simi Valley, California remains uncontained. California authorities saying fire activity is slowing thanks to calmer winds and higher humidity. 750 firefighters are working to build containment lines while helicopters drop water on hotspots. Meta is cutting jobs and reassigning 7,000 workers to new jobs related to AI. According to an internal memo, the Facebook parent will announce staff cuts later in the week as part of an effort to improve efficiency and offset its investments in AI. In sports, the Mets beating the Washington Nationals in historic fashion. New York becoming the first National League team to score at least 10 runs in an extra inning since the 1919 Cincinnati Reds. The Mets topping the Washington Nationals 16-7 in 12 innings. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Looking forward to earnings from Nvidia tomorrow after the closing bell. Numbers from Target as well through the week. Plus, of course, we'll hear from Walmart later on this week on Thursday. In just a moment, we'll catch up with Jay Goldberg of Seaport. The lone sell on Nvidia heading into a monster earnings report tomorrow afternoon. That conversation just around the corner.
There's two sectors that lead the equity market. One is energy, the other is tech. In those periods when energy lead and commodities lead, you build overcapacity. That lowers the overall price. Investors chase duration, which is growth stories, tech, and the rest of it. But eventually you run out of energy, run out of commodity capacity, and that's where we are today.
That was Jeff Currie of Abaxx Markets. Great to catch up with the legend of the commodity market a little bit earlier on this morning, breaking down on what he thinks is going to happen here. We've seen the bust a few times, haven't we? Saw the bust in mining, post the China boom, saw the bust in shale about 10 years ago, middle of the last decade or so, and that's led to a long period of this sector, those sectors being starved of capex, and Jeff thinks you need much higher prices ultimately to get that investment to come back in.
Unloved, and politics also at play. How many times have we been warned about peak oil? Also, remember, as the Biden administration talked about stranded assets when it comes to the oil space. Obviously, that's not happening now. But what's so interesting, and Jeff is basically saying we're just living off of these inventories, is when is it finally going to bleed through prices? what he is talking about in terms of the concerns of the physical market.
Jeff's talked about the revenge of the old economy. Check out the full interview on Bloomberg.com and, of course, on the Bloomberg terminal. Here's the price action for you. Going into the opening bar, the cash open just around the corner, about 41 minutes away. We've got equities down by 1/3% on the S&P 500. On the Nasdaq, we're down by 0.5. Some problems with chips and memory stocks. These are the names that have run up aggressively since the March 30th low, the end of March, and that low up by something like 70% on the chip players going into Thursday, Friday, and the problems we experienced going into the weekend. We've got some negative follow-through. On the Nasdaq, we're down by 0.6. In the bond market, yields high once again notable. 10s at 462, up by 3 or 4 basis points at the front end, and on 10s, on 30s up by 3 to 515. That's the story in the bond market. Here's the story for the week ahead and the next couple of days. Wednesday, earnings from Nvidia and Target, plus in the mix. In the middle of that, you'll get some Fed minutes. Look out for that. Let's see if there's any more hawkish dissent within the minutes. Just some hawkish pushback to that easing bias of the Federal Reserve. On Thursday, results from Walmart, another round of jobless claims, PMI data in the mix as well. On Friday, main event, Kevin Walsh steps up to the plate, sworn in as Fed chair.
That's going to be interesting. First time at the White House since Alan Greenspan in the late 1980s. It's going to be really an interesting moment for the President of the United States because he has been jawboning Jay Powell. He wants lower interest rates. But just this week, he told Fortune magazine, basically resigning to the fact that it might take longer due to the fact that energy prices are higher, and saying we're going to see where the figures are when this war is over. And right now, Jonathan, we're in paralysis with the conflict in Iran.
That's the story for Friday. Let's talk about the big story out tomorrow. Nvidia earnings out after the close tomorrow afternoon. Jay Goldberg of Seaport with the loan sale rating and a street low price target on the cheap maker. He writes, we think the semis market is going to be choppy in the near term. Nvidia remains constrained by high expectations and serious supply constraints. Jay joins us now for more. Jay, welcome to the program. What are you expecting tomorrow afternoon?
I think Nvidia will print a good number, but not a great number, and it'll be, it'll be good. People will be, won't be running for the hills, but I do think people won't see anything that will meaningfully alter the story or their outlook on Nvidia. The stock has been sort of underperforming the sector all year long. I think that will continue.
Jay, I would just love to get your read on what's going on with China. I was with the president on the trip. Obviously, Jensen Huang was a last-minute addition, picked up at the refueling stop. Do you think that this summit is going to be the breakthrough for Nvidia to be able to sell those chips into the Chinese market?
So I think there has been some progress there. Nvidia has been lobbying very hard to get access back to China. I think they've made some progress. It's always hard to tell, but I think first there's a question of will they be able to, will customers actually buy them there? I think there are going to be limits within China on purchases of Nvidia chips because just the whole thing is so political. And I think we're also at the point where the damage has already been done. We have a number of Chinese competitors already loose in the ecosystem running around, and that sort of cracked open the door a little bit on Nvidia's moat.
When it comes to that market, though, Nvidia at one point talked about it being $50 billion for them. What kind of numbers do you think actually it could represent?
I think, the potential for the market is absolutely that big, if not bigger. I think in the near term, I don't see them getting much above single-digit $1 billion in revenue from China this year, assuming the restrictions are actually opened.
Jay, can we talk about this sell rating? You've had it on for quite a while. Let's take the last 12 months. You've had a sell rating on the stock. The stock is up by some 65% over that period, Jay. What would it take for you to change your mind on this name?
So I've always positioned this call as an underperform. Like, I've never told anyone to go out and short Nvidia. That's obviously dangerous. But I do think Nvidia has grown so big and become so dominant that it's hard for it to sort of beat that, right? And we've seen that play out this year, or even longer, even late last year, where it's just underperformed the sector. We've seen a lot of these stocks run 50, 100% even in some cases this year, a lot of their peers and their competitors. And Nvidia just can't run like that. They're a good company, they have good products, but they're supply constrained. They're sold out for the year. And once you're sold out, how do you beat expectations, right? We all have a pretty good beat on what their supply chain looks like. And they have limited scope to raise prices. Adding China to the mix will help a little bit, but in the grand scheme of things, there's not much upside to expectations here possible for them anytime this year.
Jay, with that in mind, is that why you think AMD might be the better opportunity in the sector.
Yeah, I think AMD is becoming a serious competitor to Nvidia. Their upcoming product, the MI450, which is launching later this year into next year, is on paper very competitive with what Nvidia is going to be offering. I think it's the first time we've been able to say that about AMD. They've always been close, but now they're fully competitive. And we have customers who can't get enough Nvidia products, and so they're turning to alternatives. Nvidia is effectively leaving a lot of money on the table, and that's opened the door for everybody else. And AMD is top of that list.
Jay, appreciate the clarity on that. That's important. Jay Goldberg there of Seaport. AMD, the preference here versus, say, Nvidia, and that sell is not an outright sell, it's just an underperform within the sector. I think getting clarity on that is important when people see that lone sell call on that particular name.
And as you said, he's had that sell call for months, and the stock has just gone up double digits and absolutely carrying basically the entire equity market. But his point is, we know what the supply chain is, we know what their outlook is, and if they have no more chips to sell, then where's going to be the upside when it comes to this name?
At one point, we are up 20% in 7 days through Thursday last week, which is something close to, that's $900 billion plus, close to $1 trillion of market cap on that name.
I was shocked that the market just moved on the mere fact that he joined the president on the refuel stop to China to go on this trip to Beijing. But I guess the market viewed that as potentially this is an opening for that market for the H200s. Nvidia was talking about at one point a few months ago, $50 billion they can get from China. And you heard there from Jay, he doesn't think it can even crack $1 billion.
That's the main event tomorrow afternoon, earnings from Nvidia. Right now, as we count you down to the opening bell, about 35 minutes away. Equity futures still negative here and down by 1/3 of 1% on the S&P 500, down across the board, driven by moves in chips and memory stocks. That's going to be a feature of the story going into the cash open. The bond market's not helping out this morning. Yields are up across the curve. 2s are up by 4 basis points, close to 4.1%. 10s are up 3 or 4 basis points, north of 460, and 30s at levels we haven't seen in a couple of decades. You've got to go back to 2007 to see a 30-year at 515. 515 this morning and up by 3 basis points to the long end of the curve. Crude, stable, negative by 0.5 of 1% on WTI. Brent crude around 110, but the tension and the blockade continues, and that's going to keep those numbers up there. Coming up tomorrow, Keith Lerner of Truist, Monica Guerra of Morgan Stanley, Angelo Zeno of CFRA, and David Kelly of JP Morgan Asset Management. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.